You ready?
Yep, ready.
All right. Well, for ready, it's August 20th, it's 1, and this is the regular quarterly, first day of the regular quarterly meeting of the Board of Investments. We video our meeting, so everyone please be aware of that. And with that, Dana, would you call the roll?
Carl England,
Here.
Mark Nonig,
Here.
Jack Prothro,
Here.
Terry Cohey,
Here.
Bruce Nelson,
Here.
Diane Flatholm,
Here.
Maggie Peterson,
Here.
Jeff Greenfield, Jim Edwards,
Here.
Senator Thomas,
Here.
Representative Hamilton.
Here. All right, quorum present, and we have a new member, Senate Liaison, Senator Fred Thomas. Senator Thomas is the majority leader of the Senate, and your second stint is majority leader of the Senate, correct? I first got to know freshman Representative Fred Thomas back in 85 or 87?
85.
85. Well, dates us both.
You were younger then.
Yeah. And no wiser. But Senator Thomas, welcome. We have a little spot on the agenda for you, but I think most people know, but if you want to introduce yourself to us, that'd be great.
Well, shouldn't take much time, not much to say, but Fred Thomas, I'm from the business. I was born in Hamilton, grew up in Stevensville, and went to local schools at MSU, and did finance, had a great time at school, and don't regret that at all. And went home, entered into the family insurance business, and I've done that for years. Concentrate on, sold our agencies, work at Payne West, at this time bonding and insuring mainly contractors. And so I have my wife, my first wife, of 37 years I think this year, 3 kids, 3 grandkids. So that's my story.
Wow. Well, welcome.
Thank you.
It's a pleasure to have you.
Thank you.
Is there any public comment on issues within the board's jurisdiction? Seeing none, we have some minutes of the May 21st and 22nd regular meeting. Has everybody had a chance to look at them? And are there any corrections or additions? If not, is there a motion to approve them? Okay.
I'll second it.
Mark and Maggie?
Thanks.
And any discussion? If not, all in favor say aye.
Aye.
Any opposed? None. We have some minutes of the July 19th special board meeting. Any corrections or additions? If not, is there a motion to approve?
I move to approve.
Okay. Any discussion? If not, all in favor say aye.
Aye.
Any opposed? None. Move on to committee reports. Audit committee.
Okay, should be brief, hopefully. We reviewed our checklist that the board uses to keep track of things. A few of the things we discussed in that process was the IRS gave us a letter closing the bond audit or inquiry related to our Intercap Series 2010 or the tender option bonds. They closed the examination with no change to the position that interest paid to beneficiary owners of the bond is excludable from gross income. And as a reminder, I mentioned that last meeting, we talked about it, and the reason we were probably selected is because we were the only ones in the state of Montana with tender option bond. On August 1st, 2019, staff sent out the annual local government STIP account confirmation letters to 195 government entities and their authorized representatives. There have been a few changes come back, but not a lot. We discussed the RFP for our investment consultant, and I'm just going to give you the update that it's closed and we have responses have been submitted, and there's a committee of 5 that has been appointed to review those. 2 board members are included on that committee. We have a draft version of the Whiffley SOC 1 Type 2 audit report. The draft was submitted to the committee. There were no findings on the draft, it was basically a clean audit. There will potentially be a few recommendations in the final version that the board could consider, but we don't know what those are yet. The committee did recommend accepting the draft. I don't believe this board has to, full board has to take any action.
We have to approve the final.
The final we will approve, I think, in October, if I remember right. Let's see. LAD financial audit. LAD was on site from July 29th through August 16th for field work. This year they're placing a little more emphasis on providing assurance work for participants. In the audit, that includes the pension system, the university system, in-state loans, and let's see. Yeah. And they're going to be back sometime in mid-October. I was just trying to remember. Since in the past, sampling was stick heavy. They've expanded it this year. So. And this year our audit is reporting focus versus compliance. So. The financial reports are being worked on by staff. We're projecting a date of sometime in September for those to be put together. They have to be submitted to the Department of Administration by October 1st. So, what else do we have? Oh, we have a policy change, proposed policy change that the committee approved for us bringing forward to the full board, and that is on the non-travel meals. Many of you probably read in the newspaper about the Commissioner of Higher Education getting dinged for not having a policy and doing what they wanted to do with regard to meals. So our policy was submitted. Do we want to make a decision on that now, vote?
Yep.
Has the full board read the policy change? I can read it out loud if you want just one paragraph. It says, board members and staff are subject to the provisions of Title II, Section 18 of the Montana Code Annotated for meals, lodging, and transportation while on travel status. Lunch may be provided for board members, staff, necessary participants during regular scheduled meetings for the benefit of the organization, including improved communication, efficiency of time, and increased collaboration. Do I have a motion?
You're going to make it on behalf of the...
I can make it on behalf of our committee to approve this
Okay.
change in policy.
Is there a second? Second. All right, any discussion from anyone? If not, all in favor say aye. Aye. Any opposed? None. Is that it?
That's it, thank you.
Okay, Terry?
The Human Resources Committee met. We discussed the process for finding and hiring a new CIO. We determined that we will conduct an internal and external search. We will hire an executive search committee to assist with this process. We're mindful that staff is stretched very thin, and we felt that having the assistance of an executive search committee would be helpful both to the staff and to the board. Dan has provided a calendar of tasks that need to be done in a timeline. Basically, we would hope that the RFP for the Executive Search Committee would be done by early fall, that the award would be awarded in September, and we would look to have a recommendation to the board for hiring of this position at the December meeting with the new CIO to start in January. That is the proposed schedule. We do need a motion. The HR committee recommends that while all board members are very much invited to be part of all meetings and so on, formally, though, the HR committee and the chairman of this board will make a recommendation to the full board for a CIO hire, and that will be done hopefully at the December meeting. So I would make that motion that the HR committee and the chairman of the board will bring a recommendation to the full board for its final action.
Okay. Is there a second?
That's second, that.
Okay, any further discussion?
And that's for the search committee, that's for.
This is for the candidate.
Oh, for the candidate.
Right,
So.
right. And you kept saying search committee, I think you mean a search company.
I'm sorry,
Yeah.
I'm sorry.
That's what I meant.
Is that clear?
Okay, so.
So an executive search
We're not gonna-
company will
Yeah.
assist us.
So there's two steps. There's the RFP for the executive search firm. Then there is, once we go through the process of the search, the HR committee and the board chair will bring a recommendation for a candidate to hire for chief investment officer to the full board.
At the
So
December.
the November, we don't meet in December.
Oh, we've already done this.
Oh, we hired, they,
Gotcha.
because we got.
They would hire in
we have to do
November
a
and hopefully
contract.
start first of the year.
Yep.
So with that lovely motion, is that clear?
With that money.
So-
I think I'll second it again.
So the point of that is that, except for those members of the committee and those who choose to join the committee and the chairman, no one will be interviewing any CIO candidates from the board, just considering the recommendation of the HR committee and the chairman. I'm not arguing with that, I'm just making it clear that
That's my understanding. Again, any board member is more than, and liaison, more than welcome to sit in on all those, but in, you know, with the idea of saving time, we would bring a recommendation to the board.
So it's the same process we used for the last three hires
for CIO, right?
for CIO and executive director.
Not the executive search part, but the HR.
They're delegating to the HR committee plus the chair.
Well, we had the executive director meeting with the staff and
But that was all part
That was
of
all
the
part of the
HR's process, right?
just trying to keep that straight in my mind.
Right. Right.
The CIO is one of those strange positions that you hire, but they report to me, so it's,
Yep,
Right, but the statute's clear that we hire.
you hire.
Yeah.
I support the motion, I just want to make sure it was clear.
Okay. Anybody else? Questions? Clear on what we're voting on? All in favor, say aye. Any opposed? None.
The second item of business that the HR committee did was we completed the performance appraisal for the executive director. We unanimously thank Dan for an excellent job in his first year. We discussed and agreed upon upcoming tasks for the coming year. And I do need the motion. We approved a salary increase for the executive director effective October 1st that is in line with the raises given to other exempt staff. And I would make that motion.
Okay. Is there a second?
Second.
Okay. Any discussion from anyone? Questions, comments? All in favor, say aye.
Aye.
Any opposed? None. Is that it? Loan committee?
Okay, the loan committee met, and we've got three things the full board has to vote on. The first thing is an approval of an investment of the Colfax permanent funds in the Department of Natural Resources and Conservation revenue bond. That revenue bond will be $6,500,000. The projects funded through that were funded through House Bill number 8. And basically, they're Huntley project, irrigation, Lockwood irrigation district, and some other small ones. The bond will be a revenue bond. It's a 10-year term, 4% interest rate, with semi-annual payment. And so the loan committee recommends to the full board, and I'll make the motion to approve that request.
Okay, second?
Second.
Any questions, comments, discussion? Seeing none, all in favor, say aye. Aye. Any opposed? None.
The second one was another one to DNRC. This one is not a revenue bond, but a general obligation bond in the amount of $10 million. Again, that's for 10 years at 4% interest. There's some proposed water projects that are going to be in Big Fork, Funnywood, Folsom, Townsend, and Webo to to water pollution control project. And so, home committee approved this too, to DNRC, a regular borrower of ours, and using full tax money. And so I would make the motion to the full board to approve that request.
Second?
I would second that.
Okay. Any discussion, questions, comments? Not? All in favor say aye.
Aye.
Any opposed? None.
And then the last one, the legislature through House Bill 428 approved a change in our intercap program to allow tribal government entities to potentially borrow from the intercap program. So the board needs to approve indenture of trust between the Board of Investments and U.S. National Bank as the trustee who administers those funds, to add to our legal documents, to our regular governmental borrowers, add to potentially tribal government and also access intercap funds. So I would make the proposal, and Home Committee approve that proposal, to change those legal documents, comply with House Bill 428.
Okay. Second?
Second.
All right. Diane seconded. Any discussion, comments, questions? If not, all in favor say aye.
Aye.
Any opposed? None.
And so that's the report from the Home Committee.
Okay. Next up, there are comments from our TRS and TRS members. Jeff's out of the country, so
This will be
you're back.
brief. It'll be brief, it was a short meeting. We met on Thursday, August 8th, and the first part of the meeting was dedicated to our vendors for the defined contribution plans. So we had presentations from Primco, Empower, and Conduit HR, which is now Buck. We had Town of Lodge Grass adopt the deferred compensation of the 457 plan agreements, so they're not on board. And we had Upper West Shore School District 33, I have to look it up, become part of PERS. So we had a couple minor amendments. We removed one of our Franklin Global, Mutual Global Discovery Fund from the 457 plan, because we felt we had other options available. And that was it. It was a very short meeting.
Okay. All right, comments from our legislative liaisons. Representative Hamilton, why don't you go first, and almost Senator Thomas realized he had to do this, and we didn't give him any time to prepare, so.
I'll have one really short thing. It's been a quiet time during the summer for legislators, but we're about to get rolling again on interim committees. HB 715 was a study bill that includes, among other things, a study of the pension plan and risk analysis around that. Apparently, and maybe Diane can answer this better, but apparently teachers' retirement as well as Impera have agreed to put up some money to do that risk analysis in-house, and with Kavanaugh as I understand it. And we'll begin to see that information later on, but that process will start in mid-September of beginning to do the sort of the risk analysis on the pension. That might be the one thing that would be of interest to the Board of Investment. And that's all I have for now.
Okay. Senator Thomas, anything?
I really don't have anything
Okay.
to add.
All right. Well, now you're warned. Next time, if you bring a joke or
Very few
something.
words, so I don't say much.
But when he does, get ready. So, let's see, we're tab 2. Dan?
Tab 2, member requests follow up from prior meeting. You had a handout relating to active versus passive management at your desk. You have the monthly snapshot. We've had a couple of questions on the format change, so I'll turn that over to Director of Operations, Mike Pettit, to brief you on.
Question, where is the active versus passive? That
It's
is
in the back of our
Back,
books.
should be in the
Very
right-hand
back forward.
pocket.
Like back behind.
No, in the pocket.
That's what I just showed you.
Got it, thank you.
Good afternoon,
Hi.
Chairman, members of the board, and welcome, Senator Thomas. Thank you. I'm Mark Pettit, Director of Investment Operations. Last meeting, I had the pleasure of sitting with Maggie for a little while and kind of going through the snapshot, and we thought it might be a good idea. Just to run through this, I'm just going to run through, I only have a few minutes, so I'm just going to run through how to read it and how the numbers tie together. If you have additional questions as it relates to the detail or how we get to the numbers, I'm happy to answer those. If I don't get to that, and you have a question. But basically, we've got page 1 and page 2. I'm sorry, we're in tab 2.
You're going to have to be patient for Senator Thomas.
I abdicated my responsibility, but I'm not.
Right, we've got the teacher next to him, so we're
Good hands.
we're in good hands.
So I'll help you out. This is the first page. And this was originally our crib sheet, which was a one-page kind of overview of everything. And we wanted to expand this to 2 pages to give a little bit of a picture of what we invest. So page 1 is really an asset management view based on the pools that we manage. Page 2 is an ownership view. So if you were to look at these particular pages, the top section are the pensions and what they hold in terms of their investments. They hold the consolidated asset pension pool and the STIP holdings. And down below that are other types of funds, whether they're trust funds, coal severance, operating, or insurance reserves. And you can look down the columns. They hold our short-term investment pool, and they also own the trust fund investment pool. There are a number of these separately managed investments that have direct fixed income holdings directly in those accounts. So what we've done is we're looking at the complete net asset value, not just what securities they own, but receivables, payables, accrued interest. And so any direct fixed income holdings from these separately managed investments or any accrued interest as of month end that is accrued but not yet paid falls under all holdings. So if you were to move all the way to the right, you see what the net asset value for each participant is. If you go all the way to the top, you'll see what the total net assets are of what we invest overall for all these different participants. So in this particular case, it's 19,588,752. So we go backwards and we go to page 1. We look at this from kind of an asset pool perspective. So CAP is the first one. Now CAP is a component of pensions, but it's not all of it. It's not their STIP position. You have trust fund on the top left in the center. You have state fund. And then in the past, we had STIP on the right-hand side. But because this is an asset management view, it doesn't add up exactly the way the participants do as well. So what we did is we added this box at the top. So that's basically all the non-pool fixed income. So it's all the separately managed investments. It is any receivables, payables, accrued income, etc. And then if you notice in the footnote down below, because we have a different STIP number from the first page to the back page because of the overlap. CAP is part of the cash asset class owns STIP. Trust fund owns STIP as an investment, and those are kind of buried inside those particular pools. You take the difference of those 2 numbers, and that's how you come to the 160 at the top. So those 5 numbers, the CAP total, the trust fund total, state fund total, and the STIP total, plus that new number at the top, if you add those, all 5 of those numbers up, that equals the 19,588,752 at the top on page 2. That's basically how to read it. We're always available to answer any questions. If you get this in the middle of the month and you have a question, feel free to call me, feel free to call Tim. We're happy to walk you through that at any point.
Any questions? All right, Dan, I think it's back to you.
Okay, you have the monthly website traffic, just to show you what folks are looking at on our webpage.
Okay.
And then the final item, which does need your approval, is the fiscal 19 expenditure report, as well as the fiscal 20 budget. So under tab 2, there's a number of pages The portion which I need your approval on is, it begins Montana Department of Commerce analysis of IBAR's 2021 biennium budget approved operating plans. The second page, not the one that reads 8/5/2019 at the top, but
The one with
the
the
one with
yellow?
the yellow. This is for the investment program. You can see the number of FTE, salaries, per diem, employee benefits, vacancy savings. Here is our operating budget for fiscal '20 as proposed. The following page is for the bond program side of the house, Fund 06014, operating budgets as well. Couple of notes that are of warrant. We were going to need a budget change document, or BCD, to move funds from operating to personal services. However, given that we have a significant chunk of vacancy savings coming our way from a particular vacancy, we don't know if that will be necessary. So I talked with Commerce, we're going to hold off on that until fiscal year end to see if it actually is necessary. Let's see, everything else is pretty standard. The only one of note is we are out for RFP on investment consulting services. Well, we won't have a final number on that until we're through the selection process. I did build in a bit of an inflator, given that what we buy today is most necessarily going to be worth more than it was yesterday. So there's a bit of an inflator in there.
Is that in the contract services?
Yes.
So that's the big number in contract services.
That's, yes. So, other than that, happy to answer any questions you may have about the budget.
Questions? And you need these approved?
Yes, we need these approved by the board.
Do we need them approved in two separate motions, or can we do?
You can do them in one.
Okay, so is there a motion to approve the 21
Fiscal
20.
20 budget.
FY 20
Yep.
budget as presented? Okay,
Second.
any discussion, questions, comments? If not, all in favor say aye. Aye. Any opposed? None.
And then, Mr. Chairman, a few things of note. Within tab 3, you have a new page 25 and 26. State Street fed inaccurate numbers to RVK. So we have provided RVK with the accurate numbers, and these pages reflect those corrected numbers.
20,
25, 26.
so we can pull from
You can-
tab 3,
Pull from tab 3, page 25, 26, insert
the new one.
the new one.
Okay. And State Street.
It was State Street's fault. It was
They're not here to
RV.
defend themselves.
Exactly. I like.
Look at the camera when you say it.
It's not the staff, it's not RVK. Right.
Guys up in Boston.
State Street, right, yeah.
Those guys.
Within tab 9, there's a complimentary document to what Dan and Aaron will present on equity market risk prepared by RVK. Just insert that. You may draw your attention to it tomorrow. And then one correction.
Tab 9.
9.
Tab 9, that goes in with tab 9 as a comprehensive document that's there.
Was it State Street's fault that it's not
Yes.
punched?
Yes.
Yeah.
We'll blame US Bank for something. And then under tab 11, under private equity, we had Ethan presenting. That is no longer Ethan's burden. It will now be Michael who will be presenting. That's just an agenda adjustment for you.
Oh, for tomorrow.
For tomorrow. And then,
So I won't go on Ethan.
you can. It would be entertaining.
Right.
And then, Mr. Chairman and members of the board, what this agenda is structured toward is really one of the most important decisions you make each year, and that is the asset allocation. So the conversation we'll have today and tomorrow will be around risk and liquidity. So we as staff, and particularly Cabinet, who is assisting me as acting chief investment officer, can be informed around what your thoughts are and your comfort level with the asset allocation and the risk associated with it, so that when we bring you a draft asset allocation in October, we can be informed and you are informed by the conversations over the next 2 days. So it's really the beginning of a 3-part meeting of today, get an understanding of risk and liquidity, bring in a draft asset allocation to you in October that you can spend October researching and conversing, asking questions about, and then we will ask you for a motion to adopt a new asset allocation in November. So with that, Mr. Chairman, that is tab 2.
Okay. Any questions for Executive Director? All right. Okay. RVK.
Good afternoon, everybody.
Thank you.
Good to see you too. Becky Latzinger and Mark Higgins, so everybody can see you too.
Mark, it's nice to see you too.
Nice to see you too. Thank you, Mr. Chairman.
We're going to divide up the presentation between a few comments on the executive summary section of this information. So that's the first component of that tab, and then we'll move into the more full performance report. But as always, interrupt us with questions as we go along, and I'll try to give you a little bit of an update about what's going on in the market through the last few days, since it seems like a lot has happened since the end of June, especially a lot in August. So if you turn in that executive summary section to page 4, actually page 5, I'll make a few general comments on the text on page 4, but you can look at some of the capital market numbers as well.
We've got the recording.
Oh, okay.
Oh,
It'll be
great.
fine.
All right.
Okay.
Sorry.
As you know, there's been a lot going on in the market environment. We had a very strong first quarter that ended in March, and then it seems like we hit the skids in May as the markets became very concerned or upgraded their concern level about what was going on in tariffs in that environment, plus a lot of uncertainty about global growth overall. In June, some optimism seemed to return as there was some more positive news about some traction with conversations with China, but as you know, that's been an on-again, off-again situation. That certainly did spook markets in May, but we did do some recovery in June, and then August was another period of uncertainty again. So we're stopping this conversation in terms of formal performance remarks through June, but I'll give some indications about what the markets have been doing. What's been working in the market, the capital markets and the economy, certainly whatever day it is, and the mood on trade can be a positive or a negative. It actually ended on a more positive note as we look through the end of June. And a positive certainly is global central banks have signaled that they will support economies around the world. And our own Fed started easing interest rates for the first time in a long time. And it's anticipated that they have changed paths from that tightening experience. Investors have been preparing for rising interest rates for so many years after the financial crisis, and that appears to be over. And not only over in the US, and we're now in an accommodative stance, but also around the world as other central banks like the European Central Bank and the Bank of Japan have said, we're going to be in front of this. And even China now has been, in the last day or so, announced that they're going to make it easier for corporations to borrow and at cheaper rates. So the global GDP appears to be needing some shoring up, although the US tends to be one of the more healthy economies out there that's really supported by our full employment job picture at 3.7%. That's one of the biggest supports of optimism about our economy. In terms of negative environment or negative drivers, growth seems to be slowing down globally, not only in China but in other economies. Obviously, a lot has been written about Brexit and the impact on growth in that particular economy, and then the follow-on collateral impact on the rest of Europe and their other trading partners. So that still has yet to be seen, but obviously we're heading for that Brexit and probably a hard exit at that. Yield curves. You've heard so much about what's going on with Treasury yield curves in the last couple of weeks. We wrote a paper and released it last week in a PowerPoint. Actually wrote a paper about this about 4 weeks ago, and then issued a PowerPoint summarizing it last week on Friday specifically that talks about what is a yield curve inversion and how tightly is it correlated with recessions historically. Well, the correlations with recessions historically is pretty strong. And just a reminder about what a yield curve inversion is as you know, the Fed was raising interest rates on the short end of the curve. The market really was pressing down rates on the longer end of the curve. And then we saw an interesting situation where shorter term securities had a higher yield than longer term securities. And that tends to be the signal that we call an inverted yield curve. So that recession signal really rattled the markets, as we know. Last Wednesday, the Dow was down 800 points. And really there was a lot of conversation in the markets about how long does it have to stay inverted, and how much is it inverted, and how much is it really just a flat yield curve? Well, that being an event that did happen and is continuing to happen between the 2 and the 10-year security, it's just something we need to continue to keep in mind, and whether or not it's different this time, we'll continue to watch. But there certainly is one of those signals out there that investors are concerned about. With all of that as backdrop, you can see on that page 5 that I turned you to what happened through the second quarter, the calendar year to date, and the fiscal year to date. This is your fiscal year end, so I will make some comments about performance for the whole year. It feels like it was a year of 2 different halves, doesn't it? Where we ended the first half with a lot of volatility and a lot of concern on the behalf of investors, and then we ended the fiscal year with much more optimism. So as you look at the numbers at the top of this page, for the first 6 months of this year, the S&P 500 was up 18.5%. Now that contrasts with the fiscal year that was up a little bit more than half that return, a return of 10%. But the recovery since the end of the year, the bounce that we have been experiencing has been very strong. We're about the same place for the S&P 500 if you fast forward through the close of business yesterday. The Russell 2000 for calendar year to date, almost up 17%. Some of that has been retracted as we look at the last few days. But on a calendar, or on a fiscal year to date, negative. So if you're an investor that tried to make additional return by overweighting small caps, that strategy didn't work in this particular 1 year period. And it's really because of the volatility that we saw at the end of the year in smaller cap companies. They are more risky in both actual investment results as well as the businesses themselves, and we did see a loss there in the fiscal year. International equity investments were up 14. Some of that's been retrenched a little bit in the last few days. The dollar has continued to strengthen as well. For the 6 months, up 14%. For a year, a very soft return of 1%. For 6 months, emerging markets, growing economies, up almost 11%, but in the 1 year period, up 1.2. So if you're an investor that overweighted international equity in this particular fiscal year, you would have underperformed relative to others that did not. Bonds, for 6 months, the aggregate is up 6%. That is a very unrealistic number to expect in the future, but interest rates did come down. Bond prices go up when that occurs. For the fiscal year, bonds were up almost 8%. They're actually up more than our assumed rate of return or required rate of return for both of the big pension plans. You are not able to make those kinds of returns, we don't believe, in the future. It's just an unusual period where rates were going down. So please don't extrapolate the equity returns into the future. Please don't extrapolate the fixed income returns into the future. We will talk more about our forward assumptions for all of these asset classes in October, per Dan's comments about brushing off the asset allocation. As we look at calendar year to date for real estate, we've seen some of those markets start to stabilize. We've come off a period when real estate's done very well. For 6 months, up 2.4 for the general what we call core real estate exposure, highly leased buildings, Class A buildings, moderate leverage. For the fiscal year to date, returns 6.4%. And then finally, really the only thing As you look at the fiscal year to date, it actually had a negative return that was more than that small cap number for fiscal year to date was commodity investments. So in the fiscal year to date, very strong returns in US equities, weakness in international equity. For the bond market, tremendously strong returns, good returns from real estate. What does this mean for you? As you look at figure 3, the performance for your PERS plan, as you can see, the total fund composite net of fees, calendar year-to-date return of 10.4, the quarter you were up just under 3%, and on a fiscal year-to-date, under 6% at 5.7 on a net of fees basis. You can see for the quarter-to-date, you outperformed your benchmark, the same for fiscal year-to-date, calendar year-to-date, a little bit under. This tends to happen when you have very strong equity returns and you have private investments, again, that are not marked to market as currently, so they will trail when you get a very strong equity market. The ranks for the quarter, you were just below median in the 56th percentile. In the calendar year to date, though, in the top 40th percentile, in fact 37th. And then for the fiscal year, right about median. And for longer periods of time, strong rankings out to 3 years, 43rd percentile, out to 10 years, 5th percentile. The way those rankings work is you want to be number 1. So we are very close to number 1 for those longer trailing periods. So a little perspective, if you look to page 10, and just imagine a bit more detail on the capital markets, and then I'll turn you to our quilt chart and then turn this over to Mark after I give you a quick update of where markets are through the end of yesterday. A couple of reminders when you look at some of the economic indicators as we look through the end of June. On the upper right-hand corner, the blue diamond is where we were at the end of June. Look at where the unemployment rate is relative to history. For a lot of us that went through school, 5% was considered full employment. 3.7 is significantly better than that. And it's towards the bottom end of the observation since 1948. Inflation, there's not much out there. It's not a problem. In fact, the Fed continues to watch various measures of inflation, and we've been hovering under 2%. So that certainly is not a problem relative to the history that you see. Government debt is something we need to continue to watch. We mention this every time we give a capital markets update, because although our economy looks strong, we do have a debt overhang. Volatility, that particular measure in the blue diamond actually spikes when we see periods of uncertainty and concern in the markets, and that did spike, but it's come down the last few days relative to some of the volatility we saw last week. And consumer confidence is very high in the upper right-hand section, and this is observations, as you can see, since 1967. So the economic front looks quite solid. Yes, question?
Yeah, could you explain the volatility index, please?
It's actually trying to measure the volatility of the large cap equity market here in the US. And it's an indication, like for example, when 09 occurred or 08 occurred, you actually saw that blue diamond spiking towards the top of this chart. Since that time, this particular measure of volatility has been towards the bottom of that chart. We have seen tremendous returns booked with very little volatility. Some of the other things that I'd
Would
like...
this look different today?
Actually, yes, it'd be a little higher today, but it's down 7 points relative to the concern we saw last week. So it actually is moderated quite a bit. But when we get these big trading days, that number will go way up. It actually doubled when we looked at...
Yeah, that was what I was going to ask. Way up
Yeah.
means what?
Doubling from here is a significant increase.
30, 40 is really high.
Yeah,
Financial
Just
crisis
based on
one was
one
probably
day?
like 60, 70, 80.
it was really high. It was
Yeah.
at least in the 40s in 08. But it's settled down compared to where we were last week, certainly. Another graphic I'd like you to look at, I was speaking to the yield curve in the bottom right-hand corner. Green is where we were in treasury yields. As you look from left to right, you can see shorter maturities all the way out to 30-year maturities. If you look at the green, see how flat it is? It's quite flat, but you can also see towards the left-hand side of that chart that the shorter term securities have a higher yield than the longer term securities in this particular snapshot. And then look at where rates have gone from yellow, which was a year ago, to green. Interest rates came down across the board, and even relative to March, interest rates fell. So again, this has propelled the fixed income returns that you've seen. Finally, one graphic, and then I'll turn this over to Mark. If you look on page 15, if you were a market timer and you were trying to tell someone that you could predict which markets were going to do well in what periods, or what markets are going to do well tomorrow. Well, if you look at the results through June, so this is 6 months through June, and you look at a couple colors that are consistent relative to where they have been. Well, you've got the gray at the bottom, which in the last 4 years has been the worst returning. That's cash. Again, something else we want to make sure we don't have too much of. But cash was at the bottom, although in years like 2018, the second highest performing asset class when everything went negative. So that has been generally something investors have accepted, except in times of uncertainty that cash will have the lowest return. But the S&P 500 has had the best return over the last 6 months, followed by REITs. REITs are equity investments in real estate businesses, and it's a way for investors to be able to buy liquid investments in real estate. Very strong bounce, but they were also down tremendously last year, so a bit of a bounced reaction, if you will. Then we go to the small cap markets in the light green, and then in blue we have the EFA benchmark. High yield investments have done very well, that's the light orange. So as you make your way down this chart, you can see that there's not a lot of patterns that seem to follow period after period. And this is just a reminder that we're here for the long term. We're here to generate return, and it takes all these tools to really help us do that and to not experience the pain of being extremely over-allocated to one area or another, because every asset class has its day. Cash, very few times when it has its day in the sun, except for during crises, and equities usually have their day in the sun, but you never know what kind and what year it's going to occur. So with that, I'm happy to answer any questions you have about the market environment. As I mentioned, things are quite similar relative to the June update, with the exception of some retrenchment in the international markets. And the 10-year Treasury, which everyone was watching in the news on the inversion, the 10-year Treasury was trading as of yesterday at 1.6. It's kind of amazing to think investors would only demand 1.6% to lock up their money for 10 years, and 30 years for 2.08. So all those except those who are seeking a new mortgage. Investors don't like these numbers. Those who are looking to get debt are liking this environment right now.
Well, Becky, I know we're not short-term investors, but if a trade dispute or war is kind of a long-term thing in the next few years, how concerning is that?
Well, it's concerning on the economic front because of the disruption that it offers and the chance that it will slow down overall GDP. So that's a concern that also weighs on the sentiment of investors. So you have that more economic fear that builds its way into the volatility of the capital markets. But you also have investors who have the ability to react quickly to bad days on the trade front or the trade Twitter front, to actually react and just sell because risk looks like it's elevating. So this would certainly be something that we would argue means that we still have to have equity in our portfolio for growth, even in volatile times. But it's not a time, in our opinion, to really load up on significantly more equity because we don't need that volatility in this plan. We are a long-term aircraft carrier that's heading toward the destination, which is paying benefits along the way. And we can't afford to be, and really can't, quickly move that aircraft carrier in a way that adds value over the long term. So this means to us, this trade dispute issue means we need to continue to have high quality fixed income in our portfolio. We also need to continue to have other things that move differently, like real estate is helpful relative to equity market volatility. Are there other fancier things we need to be thinking about? We don't think necessarily so in your structure. But certainly, if you have the attitude that this trade dispute was going to go on for a long time, and you have the luxury of not producing returns and actually becoming much more conservative, that may seem on some days like the smart thing to do, but a lot of the market intelligence pieces that talk about timing the market, you have to make two decisions right. First is when to get out, and then when to get in. Most investors at least get the second decision wrong. And we can't afford to be out of the capital markets because of our assumed rate of return. Hope I haven't stole too much thunder.
No,
Let's
it's
go
fine.
through the details.
Great, if you go to the next section and go to page 4, some of this will be a bit repetitive, but some of the stuff that is, I'll try to cover quickly. As of June 30th, 2019, the total retirement plan assets stood at about a little shy of $12 billion. This was up quite a bit. You had a positive quarter, as Becky mentioned, up about $236 million from the prior quarter, so that's a positive. If you go to page 5, most of the assets are held in the cap, as you know, about a little shy of 11.5 billion. The remaining $351 million held in the short-term investment pool for liquidity, for again a total of about 11.8 billion. If you go to page 6, you can see some of the net and gross of these returns for the different plans. I'll focus on the public employees retirement plan as an example. And you can see comparisons versus the benchmark for each plan on a net of fees basis, and also a peer group that consists of public plans with more than $3 billion in assets. Generally, the results are positive. The quarter to date, again, a solid absolute return and also positive relative return. As Becky mentioned, for the calendar year to date, you did trail quite a bit versus the benchmark. This is pretty much all attributable to the fact that you have illiquid pools that have benchmarks that are public benchmarks that don't match those return streams. So if you look at the 3 pools that contributed to it, natural resources trailed by 1,300 basis points. A lot of that is timber in the portfolio, which is not tracking with public natural resource equities and energy and things like that in the index. Real estate, same thing, trailed by about 1,400 basis points. Again, your real estate portfolio is not like a public REIT index. And then private equity, which we've talked about numerous times in the past, you have a public equity index, and private equity, which, especially when you have a strong up market, is not going to keep pace. So that's really the source over the calendar year to date. Becky talked about longer term in terms of your metrics versus your peer group. They're still very strong over 10 years in the top 5th percentile, 20 years. We've added that recently into the report at about median, but if you were here in the prior 10-year period, that 10-year peer ranking did not look good. I mean, it depended on the reporting period, but it was in the bottom quartile. So that's factoring in, and now you're at about median because of the performance of the previous 10 years. And then shorter term, you've been hovering at about median. And we'll talk about some of the drivers probably tomorrow when we talk about the equity risk presentation in terms of some of the key drivers of that strong relative performance versus peers over the previous 10 years. Any questions on overall performance? Okay, great. Well, let's skip ahead a bit and go to page 9. And there are a couple things that we wanted to highlight here, just because there's some hidden insights, and again, it's going to relate to what we talk about in the equity risk presentation. You can see on the top of page 9, again, the net and gross returns, which are a repeat from the prior page, but you can also see, and these are rough benchmarks, and it's impossible to know the strategies of your peers, but you can see how your different asset class allocations compare to your peers, and there are some important insights here, and we deepen those insights when you go back further over the past 10 years and how you've evolved versus peers. But it shows some of the drivers of your success and also some potential drivers if things reverse of lagging peers in the future. And that's not saying you should change at all, but it's just the reality of how you differ from your peers. A couple things, if you look at the U.S. equity, if you look below kind of that first line, you can see median and high allocations and low allocations in terms of percentiles. In terms of U.S. equity, you're higher than the median, so that excellent performance of U.S. equity, particularly relative to international equity over the past 10 years has been a key driver of your performance. International equities, the opposite. So you're roughly at median in terms of your relative to peers in terms of your absolute allocation international equity. But when you look at it relative to U.S. equity, you're lower. So in other words, your public equity is more skewed toward U.S., so that's driving positive returns in an environment where international equity has really struggled. Fixed income is roughly on target, you're a little higher. The other thing I want to highlight, even though you can't, well, two things I want to highlight, even though you can't dig into the details on alternative assets, yours largely consists of private equity. That's the biggest component of your alternative investments. You're about 14% versus roughly 20% for the median. What's not captured there is you don't have any hedge funds. We don't know the extent to which it's captured because it's not broken out, but we can guarantee you this is not 19% private equity. There's a decent amount of alternatives such as hedge funds embedded in there. You're not having that has been a good positive performance driver. And then real estate, you're a little high on. That was when you first entered that asset class in 2006, 2007. It was not a fun time. But when we get into the asset class returns, if you look at the past 10 years, it's been a very solid diversifier and absolute return driver. Any questions on that? I know that's a bit much to absorb. Long story short, your equity, U.S. equity overweight, your avoidance of hedge funds, your allocation of real estate have been very helpful to returns over the past 10 years.
I have a question.
Yes.
Our cash allocation in, let's see, million, 1.7, ours 4.44. Would you comment on that, please?
So it must be on a look-through basis that it's at 4.44.
I think this is just substantive outside of question. Yeah.
So, as of, was it yesterday, Mike? On cash, we were at 8.6 within cap, all dollars, including the managers. That is one of the issues that we'll be dealing with over the coming months. We will be rebalancing the cash asset class within cap down to 2.75 for September. And then we'll be, as I mentioned earlier, deploying some capital in the coming days.
There are some plans that are more mature or less mature, in other words, more cash negative or not relative to us. There are also some plans that may hold short-term bonds in lieu of just cash, and that may be up in the fixed income number. So there's some classifications on the peers that may be a little bit different, but overall, a careful analysis of what is required for benefit payments, what the managers need for their frictional cash decisions so they can buy securities, and then what you need to actually fund private investments when there are capital costs. That's above and beyond the distributions you're getting back. That's the kind of cash planning that goes into your decision.
But the 4.44 number doesn't.
It's higher relative to other plans, yeah, it's in the top quartile of other plans.
Okay.
If you go to page 11 and 12, just really quickly, you've probably seen these graphics before on the upper left. On page 11, it's over 5 year. It's a 5-year period that's being analyzed. Page 12 is a 10-year period being analyzed, and essentially what this shows is the volatility that you're taking versus that your portfolio exhibits versus your peers, and then the return that you're generating versus your peers. Obviously, the ideal place to be is less risk, more return, which is where you are over the 10-year period. Excuse me. Over the 5-year period, you're not in a bad place either. You actually are taking slightly more risk, but you're getting a lot more return. One metric that captures this is the Sharpe ratio, which you want to be a higher percentile for the Sharpe ratio. And you can see over 5 years and 10 years, you're in the top quartile. That's one metric of your risk-adjusted returns, and you compare very favorably versus your peers.
So in the last few years on the 5-year, we've moved from the upper left to the upper right.
You cross that line just a little
Right.
bit. Yeah, and part of that is if you think about the fourth quarter of last year and having more U.S. equity exposure and a little bit more equity overall in other plans instead of other things that didn't move as much as the equity market did. That's one of the drivers that put you just to the right-hand side. Relative to the benchmark that represents your investment program, you have significantly less risk. And that's the difference between the green diamond and the blue dot as your benchmark. So you're to the left of that, but it's a fair observation that yes, you've moved a bit in the last 5 years. Over 10, you're still in the same position. You're still in that northwest quadrant with that green diamond. But
And it's hard to get attribution here because you don't know what each of these plans are doing in terms of the allocation. I guess one thing linking to the presentation that we handed out, if you look at your total equity, it has increased over the past 10 years. Now, it's not, you didn't flip a switch and it went up. It's been gradually increasing. So, I mean, that would be consistent. You've been moving up a little in risk, at least in terms of public equity. I mean, not a huge amount. I think it's about 5% more than your peers. That could be a cause, but it's really hard to place attribution there. However, one thing that does catch it is that Sharpe ratio, which is, yes, you're taking a little more risk, but you're getting paid for it, and you're top quartile in terms of your Sharpe ratio. That captures essentially your excess return versus a risk-free rate relative to the volatility of the portfolio, and it's positive. It's actually not that much different than, it's pretty much the same as the 10-year.
But one other thing before we leave this exhibit, Carl, a reality check on risk. If you look at that horizontal axis for 5 years, the standard deviation is 6. When you see our asset allocation study in October, the forward assessment of risk is assuming that markets actually trade at a level of risk that looks more similar to the entire history. And it's going to be double that number. 12. In the region of 12% expected total plan risk. Here it's 6. And the reason is our markets have basically been going up when we think about equities since the financial crisis with just a few blips. That's a very unusual period of time and we should not use it for planning. So we're preparing for risk. We're thinking about risk. And I know you're going to hear more conversations about risk tomorrow, but that number is very low for a total plan.
So, all right, so make sure I understand this. So you're saying the 6 is very low?
The 6 is low. Yep.
Okay. And you're saying that in your projection or the future, the next time we see this chart, it's going to be 12?
No, the projection of the future based on what we would believe are the asset class expectations, so forecasts of future markets, of future interrelationships between asset classes and their relative direction. From the asset allocation conversation and study we had in April, your current portfolio at that time was expected to have a risk of 12.6 on a long-term basis.
Now,
So a lot more volatility.
Some of that too is, I mean, the private equity assumption for, it probably does reflect the underlying volatility. There's actual volatility of the valuations of private equity firms, and then there's the appraisal process, which dampens that volatility. So, it's unlikely to hit 12 because we're capturing actual volatility expectations but on a reporting basis, it's gonna be lower than that, but if that makes sense. So private equity firms, you know, don't really capture the volatility of their underlying holdings.
They could mark to market every day.
Exactly.
But for planning purposes, just to the total messages, don't expect 6% as being your risk
Yeah.
factor going forward. And how to think about that is you look at the return that you've earned for this particular 5-year period, and 2/3 of all observations have shown that your return is +6 or -6 around that number.
2/3.
That's one standard deviation.
One more time?
So risk, if you take the return that you've earned over the last 5 years,
Okay.
this is showing you 2/3 of the time you've been ±6%.
Okay.
And actually, for planning purposes, you should really think about your return being plus or minus about 12%.
That's 95% of the time it's gonna be, let's say you have an expected return of 6, 95% of the time on an annual basis, you're gonna get somewhere between -6 and 18.
That's
Or
okay.
2/3, yeah.
And 99% of the time, you're gonna
You really hope.
get -12 to +24.
We'll get into the math more at asset allocation time,
Well,
but
I mean,
since
not
the
quite
door was
hit that.
open.
That return, up turns down.
Yep.
Whoa, does that get you?
And
So
that's
there's
like
the
markets.
reason. Yeah.
Whoa.
And that is the feedback we will need from the board for the asset allocation.
Yes.
As we look at the ranges on domestic equity, as we look at the ranges on private equity, private investments, those peaks and those valleys are what we as staff need to get your comfort level with to bring you something in October.
And asset, I mean, if you have to break it down to the most fundamental level, and jump in if you need to, I don't want to simplify it too much, but asset allocation is about matching your return objectives for the long term with your ability to react or not overreact in crises, whether it's for actual liquidity needs and you have to sell things in a bad environment because you didn't have enough liquidity, or which is more common, psychological needs, which is, I didn't know markets could go down this much, we need to get out. Because if you're saying it at that moment, you had too much. So that's really what asset allocation is about at a high level.
And it's the commitment, if you've chosen that mix, that general mixture of asset classes, and you're comfortable with what some of those years could look like in the equity market or any other market, that you're committed to staying in those investments, even during those times, and even adding money back to them when they're cheap and they've corrected, because that's the way you're going to experience a long-term return that you're hoping to. But if you actually bail on those asset classes when they're correcting, those are the corrections that you can't come back from if you don't reinvest.
And it's going to happen, 100%, it's gonna happen.
Yep.
It's gonna happen.
So when?
Most of the
Well,
time?
that's the thing, you know.
Is it gonna be most of the time it's 100%, or is it gonna be?
It could be tomorrow, it's probably not gonna be tomorrow, but
Well,
I watch it be tomorrow.
and not saying that
And yeah,
and to think all the world central bankers are coming to Jackson Hole this weekend to talk about, and everyone's going to be listening to Powell's comments for attitude, for signaling. As of this point, about 74% of economists believe that there's going to be a recession within the next 2 years, and 38% of them think it's in 2020. So even with all the volatility that we've had, actually these statistics have been around for the last couple of years. It's just a recession keeps on being kicked down the road further and further. But investors can react to them, as we know, as they did at the end of last year.
Okay, well, we go to page 14, and you can see the three main pools, the CAP, the trust funds investment pool, and the short-term investment pool. In terms of performance, the CAP doesn't go back quite as far as you know because there's a change into breaking out the individual fixed income asset classes. So, you know, assuming that stays in place, it would take a little time to build up a long history. The trust funds investment pool is primarily fixed income. The one thing that has helped returns, in addition to rates dropping and getting an 8% return for the fiscal year in that pool is phenomenal. A decent portion of that is coming from real estate, particularly over the long term, having I think it's mid-single digits of real estate in the trust funds investment pool, but also the drop in rates and the 95% that's fixed income has done phenomenally well there as well. Short-term investment pool, unfortunately, got used to some higher returns. That's going to drop a bit with the Fed cutting rates, and if economists' expectations are correct, despite the Fed not necessarily committing to it, you're probably going to see some further drops, but on a relative basis versus the index that you benchmark to, which is very short-term, essentially 1-month Treasury index, and also a sort of peer group of money market funds, which is actually on a gross basis, so you compare more favorably than it would indicate here. You've done pretty well with that pool. Moving on to page 15, you can see the breakdown of the CAP according to the different asset classes and really sub-asset classes within fixed income. Just kind of reiterating the point, you do have quite a bit in equity, which is critical in order to generate the required return, the actuarially required return of the retirement plans. About 60% in U.S. international and private equity, and then depending on the particular investments in real estate and natural resources, you also have some equity. And then the remainder in fixed income and a little in diversifying strategies. In terms of on the next page, you can see the relative performance of each of the major asset classes and sub-asset classes. Starting with domestic equity, you've had a pretty massive calendar year to date return of about 19% on a net of fees basis, outperforming by about 23 basis points. However, over longer periods of time, you have trailed by a decent amount. Over 5 years, about roughly 90 basis points, all the way up to 10, about 45 basis points. Relative to peers, you've been hovering around median, depending on the time period. You have shifted to more passive here, but as we've talked about in the past, U.S. equity is a pretty tough place to outperform, particularly in large cap. You have shifted a bit more toward passive in that area. You also do have some overweight to small cap, which hurt as well. But it's kind of a mixed message. You're doing okay versus peers, but you have trailed versus the benchmark. International equities, sort of the opposite story. Your managers actually have added value pretty consistently over the past 10 years. Versus peers, you've been below median depending on the time period. It's hard to gauge what exactly is going on there because we don't know how your peers are allocated. But long story short, the managers have added value, but either not quite as much or the allocation is different within international equity versus peers, such that you've trailed them a bit.
The peer information is in a couple of pages, so Mark was just giving some.
Yeah, I'm sorry, I'm
that
going
you'll
to the
see on
next.
19.
But yeah, you can see the peer rankings on page 19. So international equity has actually been improving, but still kind of looking at that 5 to 10 year period, we've been below median, and then the domestic equity has been hovering around median, a little above over longer periods of time.
Is any of the can you calculate the number, because the domestic equity custom, the benchmarks are all going to be gross fees, right?
The benchmarks are
yeah.
gross
Gross
fees.
So, I
Right.
mean,
We're not net.
is there a number that you use? I mean, is there any number?
No, I mean, generally, the cost of indexing in U.S. equities is very, very small, very low single digits.
Oh, okay.
International's a little bit more expensive than that, but the indexes are always reflected before fees. That's just the way.
If you were to index this, you would be not far off the index. I mean, you're 3 to 4 basis points. I don't
Yeah,
know.
or it depends,
With
if
your
emerging
amount of
markets more
money. Yeah.
expensive.
Well, that's for U.S. equity, but yeah, maybe pretty close. The fixed income, the general trend, without getting into all of the numbers, if you look at the individual segments, we don't go back beyond a year yet, we can't get out to 3 years, but it's a similar trend if you recall the fixed income pools in prior years, the internal management, in addition to being very inexpensive relative to outsourcing this to managers, the performance has been quite good. The one area that has lagged a bit is the high yield segment, and this is really due to the managers in that portfolio are more conservative by design, and you've seen a pretty good run up over the past year or two in high yield, particularly over the past year, 7.2% return calendar year to date, 9.4% return, and you've trailed them in that type of environment. The natural resources, hard to comment in the short term just because the index is so different from the underlying holdings that you have, especially timber. But
on those, you've got some longer term numbers, aren't they? I mean, not here in this table, but I guess I'm worried about natural resources.
yeah,
So talk to me about why it should be a natural or an asset class.
Generally, it's one of those tools that you can use or be exposed to as you prepare for inflationary environments. There are some components of inflation. Obviously, the big mover in that area that people hear about all the time is what's going on with oil. This particular benchmark that we compare you to is natural resource equities, and you don't have just a natural resource equities portfolio. You've got timber and you've got other investments that are also private. So it is a tool that is seen to be used as a diversifier from equity risk that is helpful in inflationary environments.
I would say timber that was previously embedded in real estate, which is, a little different than real estate, but it's not an uncommon investment for diversified, large real estate portfolios. When you start getting into, people invest in gold and precious metals, that's starting to get into more inflation hedging type assets, but timber previously.
In our portfolio, there's like oil and timber.
Yeah.
Yeah.
But you have to have two sets of expertise to analyze each one of those.
Mm-hmm.
And I'm worried that we don't have the expertise internally to analyze the managers that may be in those markets, because there can be, under that asset class,
A broad.
Yeah, I think that's a good question.
Yeah,
So
Ethan.
yeah.
To maybe address it is, we've specialized even in the last 6 months, more than we have previously. So we now have a director of private investments, and we have a director of real estate and natural resources. So we've given ourselves more opportunity to be more specialized in that specific natural resources world, in that specific real estate world, in that specific private investments world. We're still talking at a baseline debt, equity, manager selection. We have some of, and I look to you to validate this, but we have some of the best due diligence processes of any of our peers. So I think that the board and the legislature have taken the steps to give us more specialization into that asset class. Looking back at a 10-year period, since it is so poorly correlated with equities, we've had a great run on equities.
Yep.
So natural resources are not going to be as much of a return driver as they otherwise would have been.
I think you have MLPs in there, which have some pretty attractive, are the MLPs embedded in? Yes. Yeah. They have some pretty attractive attributes, and they're very similar. I mean, they're essentially a form of U.S. equity. But I mean, it's a good question for the asset allocation review. I don't know if there's a clear answer, but I
remind the chairman.
And of all the committees that we work with, this is one of the more uncomfortable asset classes just because of some of the things we've just been discussing.
I can think of one that's more.
Jim?
I can too.
Yeah, on page 15 that we went on earlier, on your report, it's the whole commodity thing, like 8 out of the last 10 years.
Yep.
It's been the dog, it's been the dog or near the dog.
Yeah.
Yeah, so,
Now, your portfolio is, it is different. It's not like those commodity indexes they have all kinds of, your portfolio is very different. It's timber, MLPs.
then what's being reflected.
Yeah.
Exactly.
On page
Yeah.
15, it's just the index that's giving you a broad array of what's happening in prices of a number of different types of
Huge
commodities
basket.
without any active management in there whatsoever. It's just rolling forward contracts.
Yeah.
Well, it seems like you kind of got to be a genius to do well there.
Well,
So-
it,
And
and,
that index, yes.
yeah. And
If you're
think,
investing someone in that index, yes.
yeah.
Bruce?
Are REITs in natural resources? REITs?
No, they're in real estate.
They're in real estate?
Yeah.
Yes.
Okay. All right.
There are such thing as timber REITs. There's a couple out there. So they're formed like a REIT, but when you think of REITs, traditionally it's real estate. Companies that are in the real estate business.
There's almost an argument
Have
where,
exposure to real estate.
Sorry.
correct me if I'm wrong.
Real estate
Oh, sorry.
investment trusts, so they're
Yes.
confusing me.
Yes,
as to
same
which
thing.
Categories.
Mhm.
Thank you.
Sometimes they're classified as equities because they are equities and they're highly correlated to equities. Sometimes they're a dry powder for investing in traditional real estate because they're liquid.
I think we covered natural resources. On the next page, real estate, we had mentioned, this has been, over the past 10 years, it was again, it was a very painful start in 2006 and 2007, although the allocation was much smaller back then too. So when you took the brunt of the hit, it wasn't as much money there. But the returns over the past 10 years have been very strong, about 8% net, roughly in line with the index, but again, that's not, that's a very rough metric over the short term. And over the short term, because it's a public REIT index, a huge run up, calendar year to date, the index has returned about 18%. You flagged for that reason. The diversifying strategies, I will talk very briefly about that. But essentially that consists of two tactical, what's called global tactical asset allocation managers, and essentially an investment in long treasuries. And it's been roughly even with the market. That's been, since the inception, over the calendar year to date, it's been up. It's been a function of the index is an intermediate treasury index. When you have long treasuries and rates drop, they're going to go up a lot. And then the GTAA managers, they have a lot more than fixed. They're not invested in intermediate treasuries. They have a decent amount of equity in them. So you have a huge equity run up. They're going to outperform that as well. That's designed as a very long-term benchmark. You're actually getting some positive, essentially tracking error in that portfolio versus the index.
And we have conversations on that particular asset class diversifying strategies, and we're going to be talking more about that in the asset allocation.
And then, the cash is what it is. Don't expect those huge 2.3% returns going forward as the Fed cuts rates. But the actual management of the cash has been pretty effective. And then the private equity pool, everyone's favorite conversation. Because we talked about it every time over the past 10 years about the tracking error, but you can see that over all time periods, it's been particularly volatile lately. You can really see that in the calendar year to date. You have that huge bull market, and that gets reflected in a public index. It doesn't get reflected in the pool. It's a delayed realization of those types of gains, even though they're probably experiencing the same thing underneath. But then you can see the opposite in 2018. When the public equity market index tanked by just shy of 10%, I guess, 9.99, the outperformance in the private equity pool was pretty massive, at almost 2,000, more than 2,000 basis points. So this is the type of thing that you're going to see in the short term. In the long term, hoping to get better or at least equal to public equity net of fees returns and in a diversified manner. It's going to be a little tough over the past 10 years because you had a raging bull market, and you also had some built-in, because of the length benchmark, you had some built-in alpha expectation there as well. Overall, it's a very strong diversifier, which you can actually see on the next page, on page 20, where you see, this is the beta page, where essentially you see how different asset classes, the beta to a public market index, and the lower the beta, essentially, the greater the diversification. And you can see on the bottom, the very low beta asset classes, real estate, private equity, and then fixed income, and that mitigates the volatility of the portfolio, which is the portion of the portfolio that is invested in equity. So that's a high level. We'll talk about some of the risks in the equity portfolio with the equity allocation tomorrow, but overall the portfolio is performing well, and there are going to be some important conversations when we get to asset allocation on some of the smaller portions of the portfolio, the diversified strategies, and it sounds like there are questions around natural resources as well, but overall the plan is performing well.
I had a question. On page 19, when we look at these different investment pools and then the benchmark for them, or I guess the comparison to public plans, we got, I always find this hard to read because we have inception dates all over the board.
Right.
And so we come back to the 10-year column and everybody made it 10 years, but is there some way we can see sort of these numbers relative to the longest since inception date, where everybody had a common inception?
Yeah, that's the issue, is not your numbers, it's actually when the universe has those numbers. So if we actually showed you as long as the universe had them, you'd be missing out on seeing some of the returns that you actually generated during that period. So that's a trade-off. Usually we've gone with the assumption that you want to see the longest term number since you've been invested, because we do have indices to show you. It's just we don't have the comparable peer groups that go as far back as 97, 95 in some of those cases. So yeah, it's one of those things where if you look at versus the indexes, it's not a problem, but versus the peer groups, that is an issue.
So it would seem like from these inception dates over on the right-hand side, but I guess I'm not sure if that's our pool.
Yes. Yeah, that's the date your pool was incepted. It's not the peer group.
Oh.
So the way you can read this is the since inception number, you look down this list and look at the dates. You've got a very long period of time to say, hey, this is pretty representative of what fixed income has done for you since 1997, a 6.13% rate of return. If that inception date was 2015, you'd say I probably can't put a lot of stock into how good that return number looks, but you're right, the peer groups just don't go back that far.
So I don't really have the information between the 10-year number, which we can see because there's a pool and a peer group number there.
Right,
So
really.
we're sort of flying blind between 10 and 20 years.
You are, and really the answer to that is, we look at comparisons versus a benchmark if you have one, and then against a peer group. And sometimes you don't have a peer group and you need to pay more attention to what's going on with the index, which is back on pages 16 and 17, where you've got the benchmarks that go the full period of time on the since inception. And again, that's usually not the problem with the peer group.
And the more niche these asset classes get, the more difficult it gets to extract meaning, because you don't know what is in the real estate portfolio of peers. It could be very different than yours. So even domestic equity, I mean, that's pretty good. You could be a pretty good indicator, but some plans can have very different strategies for very legitimate reasons. I have one client that needs, for a very legitimate reason, needs more income. So they have a strong value bias and they trail peers by a lot, but they're not going to change because they can only spend income. So, you know, you have to take these with a little grain of salt. They're useful at the extremes more than they are when they're hovering around the middle.
You can take a minute if you need to, and anything in the manager report from page 32 on that we would saw that we need to call our attention to.
You know, we looked through it and we checked with our manager research beforehand. We have been helping with, you know, a few manager searches. I know there's a change and staff will talk about the change from post, which there were issues there that we essentially had a portfolio manager leave for, you hear personal reasons, you don't always necessarily believe it, but you know, there are real personal reasons for it.
Spend more time with his family?
No, no, without getting into it. There were legitimate reasons for it. And, you know, to no fault of his. And, you know, so we worked on that. You know, in the GTAA, and I know there's a conversation about that, and, yeah, I guess we'll talk about that at a later moment.
Okay.
And other than that, there's nothing really that stands out at the individual level. More, you know, I mentioned the domestic equity has been trailing for a while, and that's something that begs a legitimate question on, you know, do you want to look at that and see if there's some changes, you know, potential changes you can make down there, and make it in that portfolio down the road.
Okay. Anything else for these guys? You're coming back, right?
Yep, we're here.
We are.
Both days.
All right. Anything else? If not,
You know, I noticed there's no break in the.
it comes, if you turn the page,
Gonna
you'll
just
see it.
work.
Yeah, It comes here in a minute. All
That's
right,
the dessert.
We're going to do tab 4 first.
Thank you, everyone.
Thank you.
Really
Thank
appreciate
you.
it. Good questions, as always.
John?
Mr. Chairman, members of the board, I'm on tab 4. Welcome, Senator Thomas. Just a small change here to our policy statement for the poll tax trust. So the legislature made a few changes to a couple of programs where they just changed the limit, as you see here, and one where they added a new program. So recall, our poll tax trust fund has 6 sub-accounts to it. This is just one of them, and I only included the objectives and guidelines that had a change associated with it. I didn't print out the whole 20 pages of the poll tax trust fund, but a fairly straightforward change here. If you want to know more about program things, you can ask Doug, and he's back there, so I don't know. But happy to take any other questions that you might have on these changes. If not, we do need a motion to approve these changes from the board.
I do have a question probably for Doug on that multifamily one. They're in the rule-making process, the way I understand that.
That's correct.
Is there a timeline when we'll know go through?
No, they had a public meeting last week. There was very little attendance, but there's no set date as far as when that program's going to be up and running. The Board of Housing will be administering that program.
Okay.
One thing we're wrestling with internally is how we account for these policy changes and how they reflect in the returns. So where the legislature makes a determination that X dollars will be allocated to this purpose, it'll have a drag on returns for us. So we're wrestling with how we account for those sorts of things, because it will impact across the entirety of protocol. So we haven't quite figured that out, but it's something that as larger allocations from the coal trust are made to it and to these sort of special funds, we'll have to figure out some way to account for it.
Is that reflected in the fiscal notes when they're?
Yes. They're not as good as they were about a year ago, but.
They're very timely though.
Oh,
I'm not sure I know the question. So don't.
I would so move these, is that appropriate now?
Yeah, yes, that would be now. I'm still trying to figure out the question.
Yeah, what was the question?
What was the question?
Whether or not the direct, so when the legislature makes a determination that X million from the coal trust will be put toward multifamily or this, that, or the other, there's a rate implied, there's a rate assigned. That may or may
Signed by
not,
whom?
the legislature.
Okay.
That may or may not be in excess of what we could earn investing the funds. So the question for us is, how do we account for that drag on earnings within trust fund without it reflecting on our performance, but rather there's been a policy decision made elsewhere that we are the mechanism to implement. And as larger and larger portions of the coal trust are allocated to multifamily, veterans home loan, those sorts of things, it shows up in our performance of what the trust funds are earning, but we didn't make the determination on how those dollars should be invested.
Well, it's not an audit finding.
It's not an audit, it's a...
It shows up as a red, it might show up as a red number that we have to be able to explain.
Correct.
My question was just, is it reflected in the fiscal note, in the legislature's considering the bill?
Right.
But remember, the fiscal note only reflects change from current law. So where you have zero, for instance, several years ago, there were $0 allocated to veterans home loan. Now it's up to 50. The fiscal note only shows the difference between 40 and 50.
Well, there's a focus on the impact of the general fund, not to
Right.
investments.
So the fiscal note only
It's
shows
included
the
in the
impact
notes.
in the general fund?
No, I think it
Usually in
goes
the notes.
beyond that, but I said the focus of it is on the impact to the general fund. That's what we're paying attention to, not what the investment earnings will be or not be here.
I do think it is part of the notes, however, where it will be noted that portfolio is earning
Right.
and less therefore than the main portfolio.
So, correct, and in the fiscal note, God, I spun this out, I'm sorry. For us, it shows up as a drag on trust fund performance.
Right.
So we've just got to be able to represent that somehow in the future.
But that's, okay. And if I understand you right, what you're saying is we have to be able to explain that drag sometime in the future when someone says, why
Why are you below this, that, or the other?
Okay. It's not an auditing issue of that.
It's not an auditing issue.
I have a question. I'm sorry. I remember one of these as being a 2% rate. Do you happen to know what the rates are for lending that we?
Multifamily has not been determined yet. IRB,
Is at 2%, that's by statute. Veterans Home Loan Program is 1% below the market rate, and that's by statute. So the Board of Housing determines the market rate, and then our return is 1% less than that. When I do my in-state loan review, I usually get a return that we currently made on the Veterans Home Loan Program, so you'll see the return there. The return is going to be less with rates currently where they're at. So any new loans coming about with this $10 million increase, the return will be less than what it has been.
Good investment.
Yes.
But in theory, at least the increases is all were due, in fact, were due to the fact that these programs were well, right?
they fulfill the legislative purpose.
Right.
Yeah.
The legislature felt it was a good idea to do this. As a whole, they did.
Okay. Was there a motion? Did you make a motion?
I would move that these changes are adopted.
All right, is there a second?
Second.
Is there any further discussion? If not, all in favor say aye.
Aye.
Any opposed? None. Motion carries. Oh, is that all? That's it. All right, so we're about 15 minutes ahead of schedule, so why don't we take a 15-minute break and come back 15 minutes early? Does that work?
You are making Jack very happy.
All right, well,
That's his.
all right, so we are at tab 5, right? The public market investment manager change, Randy and Mike. What'd you say, you're the Terminator? You're the Terminator and you're the cleanup guy? Okay, now we can move on to tab 6. Go ahead.
Mr. Chairman, members of the board, one manager change in the public markets area this past quarter, and as you heard from RDK, we terminated our relationship with the Post Advisory Portfolio High Yield Bond Manager. We've been with Post for quite a few years. They have been one of our more interesting managers, you might say, with more turnover than most managers within our area. The most recent one, though, was the most significant, where their chief investment officer decided to retire. And the way Post has been structured is he basically built the investment staff and hired a lot of people that he knew in the business, and they came into the organization. And even so, he was still kind of like the guy that made the decision. So it wasn't, an actual team of 4 or 5 or 6 portfolio managers that managed the money. He was the guy that made the decisions that made the engine go. So given that and our experience with them in the past, we thought that it would be best to no longer be invested with them. It was an easier decision, and also in that we did have 4 high yield managers, and so we were very diversified, and we feel that even having 3 rather than 4, the overlap between the portfolios was pretty substantial, so that we still have the same positioning, largely the same downside protection with the 3 that we have collectively as we would have had it before. So it was a little bit different in moving the money than what we've done in the past, and I'll let Mike talk about that.
Okay. Given this is a high yield portfolio, it was really kind of broken down into 2 pieces. One is cap, so Post managed the portfolio in the pension pool, and they also managed a commingled fund in the trust fund investment pool as well. So in looking at this, we needed to dispose of the assets in cap, which were individual high yield corporate bonds, as well as a stable of bank loans as well. So rather than looking to a transition manager for these types of assets, we actually reached out to 2 existing managers, Oaktree and Shankman, and we basically shared the list with them. The managers were able to assume all the high yield corporate bonds in the portfolio, so we avoided having to sell any of the issues. The one exception would be the bank loans. The bank loans tend to be a little more specialized. There's a lot of documents and paperwork that are generated in the manager's name, and rather than assigning that paperwork over and taking longer for the transfer, it was decided that a portion of the portfolio less than 10%, which bank loans, we had Post sell those bank loans, and then the final cash proceeds were then again allocated to the existing managers, Oaktree and Shankman. So basically, we didn't have to sell any securities, didn't have to incur that cost outside of the bank loans, and we were able to distribute those between the 2 existing managers.
The bank loans were a fairly small portion of it.
Yeah. Did you take a loss on that?
On the bank loans, that I don't know.
I mean, it wouldn't seem like it's a big deal to transfer.
Well, the bank loans, are usually negotiated individually between the manager and the counterparty. So it's not like a high yield corporate bond, whereas if it's on the, let's say we looked at Oaktree or Shankman, they can look at their approved list to make sure it's listed on their approved list. The bank loans themselves are basically custom securities that the managers created with those.
So the new manager may not have wanted to take it, or?
The new manager's recommendations to us, both Oaktree and Shankman, were to have post-sale bank loans.
Could have been, I suppose it could have been a breach, I mean, it might have been unassignable.
Well, it could be assignable, but the amount of work that would take to assign those loans, based on Post's recommendation as well as Oaktree and Shankman,
So
it
there
was
was,
less than 10% of the portfolios.
yeah, I just was trying to visualize why it's so much work. I don't mean to dwell on this, but why is it so much work?
I think that they're probably bond indentures or whatever contractual documents that were basically created by Post when they initiated the bank loans. Those needed to be basically assigned. To sell the bank loans themselves took anywhere from 2 to 3 weeks to sell them and settle them, whereas a typical bond itself in that market, it settles 2+2. So just to sell them and transact the cash was extended. If we were to reassign the loan, it could have taken months for that process to take place.
Okay, thanks.
So oh, go ahead.
Oh, I just asked, is the market on, it's a daily market, obviously.
That's correct.
Is it a very liquid market? I guess what I'm wondering, I always thought there was a huge gap between the bid and the ask on those, but has it tightened up now or something? So, you know, obviously, they took them at what the market value was and gave us the cash for it, right?
For the bank loans.
Well, no, I was talking about the high-quality corporate bonds that.
Those were actually, we took the list of assets that Post owned,
Right.
and we gave that to Oaktree, and we gave that to Shankman. And they went through the list, and rather than selling those, they said, okay, these are on our approved list, we can take them.
Well, I'm just asking at the price they took it, you know, I just.
Yeah, that was my question too, is what, describe that.
So the way
in
we
terms that I
actually did
can-
the process, we're actually moving the security free to them.
Yeah,
But from an accounting and a performance perspective, they do get priced every day. So we took the prices that State Street gets from our pricing source.
so there was no bid or ask, it was what was showing as the price of that security and they took it
As
at
of-
that
yeah.
price.
Yeah, so we moved it as of the day of, so let's say, I think the actual transfer, if we looked at the actual transfer here, 6/7 was basically the post date for these particular transactions. So we took the price
On that-
as of that time, we sold it out of the Post account and bought it into the Oaktree or Shankman account.
Right.
And so what that did is it finalized the performance for Post, and it gave a new starting point to measure the new managers from as well.
Can you estimate what you think you saved by not having to do a transaction to sell them?
That would be more difficult, because that would in fact involve the bid-ask spread.
It sounds like a really good deal, I'm just interested in how that all worked.
Well, what was our spread, what was it with the April transition? How
Well,
many bips did we get?
that was domestic equities, which are much more liquid than the high yield market. Bonds are traditionally, more difficult to sell and trade, and high yield, again, can be even more difficult than investment grade. So, tough to say, like Mike said, but it would be significant. Like, we had to sell all those securities and then, buy whatever Oaktree and Shankman wanted to buy, rather than take those.
Well, thanks.
So,
We could probably back into something like an we could go look and find maybe an average bid ask for.
Oh, I know it shouldn't really work, I'm just sort of interested, I mean, I just thought it was a smooth move you guys did, no.
Yeah, well, I appreciate that.
Yeah, we thought it was pretty smooth.
For a Terminator, yeah.
Even though these are marked to market every day and we have prices for them, they tend to be more illiquid than, let's say, an equity might be. So that's kind of one of the reasons we went down that route. The second piece of this is the allocation that the trust fund had in a commingled fund. It was, all total about $103 million. And so, looking at that commingled fund, there could have been some potential expenses or holdbacks depending on how fast we took the money. So given the fact that Post was managing money for other clients in that fund, and we were not the sole investor leaving that fund, we are more comfortable leaving that money in there a little bit longer. So we did it in 3 tranches. So the first tranche was $50 million that we did at the end of, effective June 30th, which settled on July 3rd. We did $45,500,000, which was effective July 31st, settled 8/5. And then we've got one final piece that will be effective 9/30. But because it's the final amount, we're not specifying the dollar amount. Once their audit's done for month end, they'll send us the wire. So this one will be a little bit later, kind of mid-September, but we expect to get the final amount, about $7.5 million out of there in that piece. But we felt it was a little more prudent to do that to avoid any charges, any extraordinary charges from the fund. And we felt comfortable given that there are other clients that they're continuing to manage money for there, so we didn't worry about a performance issue by us terminating them on that.
When you when it gets transferred to Schenkman, to buy into another commingled fund, or
We didn't go into a commingled fund, so basically with the first tranche, we gave the money to Schenkman, the second tranche, we gave it to Oak Tree, and then this last tranche, I think we still have to allocate based on what Randy decides at the time.
But into a separately managed.
But
Into a separately managed account, yeah. Gives us a little more flexibility there.
I'm sorry, Michael, I might have heard you wrong, but did you say that that last third tranche is the end of August or the end of September?
Well, the trade date is the end of August. We'll actually get the money in mid-September.
Okay, so it will be completed by September 3rd?
That's right.
Yes. I don't think it was my ears.
Well, when we always hear that these are liquid funds, is that really true? I mean, you could have done them all at once or whatever, you just decided to do it this way, but you weren't surprised by the liquidity or anything?
Well, I think what we did is when the time came, that the decision was made, we go into kind of the documents backing the fund that we had signed years ago and look at all the potential cases, in terms of what could happen, and based on that, we're kind of deciding the best course of action.
So you said by splitting this, did you avoid some extraordinary charges? Did you say that?
Yeah, potentially.
And was that discovered when you went back and looked at?
That was at the beginning, because initially we had looked at taking all the money out entirely, and then we noticed that there could potentially be a charge based on certain thresholds. So that's why you see the thresholds here was first 50. You'll notice that 45.5 is about 90% of 50, so we're kind of following that rule of 90% in order to keep taking.
Fred and I both went to Bozeman, but we followed that.
Yeah. So we're kind of we're trying to not withdraw more than 90% at a time, and that helped us avoid some potential charges there.
So the charges are that they're in the contract, it says that you withdraw more than X percent, you pay an extra fee.
It's really not so much a fee more than a holdback. So what the holdback does is it extends that final payment to later, once their annual financials are done in the spring. So the holdback could be a certain number, and if we took all of our funds out at one time, the entire balance could be based on that holdback, which could be quite a bit of money. We still get it back, but we have to leave it with the fund for a certain amount of time. Here, what we were doing is we were taking chunks out, not to breach that 90% threshold, so that when the final amount came down, the 5% holdback is of this rather than this. And so that's the final piece that we're waiting to see. You know, we're working on the final redemption now, and we're hoping that the holdback won't apply. But the holdback is not necessarily an expense we won't get back, but it'll be something that might sit out there until after their annual financials are done in the spring.
So, Mike, I just have a question here. You said 103 million, so is that 6.5 really 7.5?
Yes, about 7.5
It's not
is what's
6.5.
estimated for this final payment.
Keep in mind, we're still
Yeah, I just want to
invested, so
estimate
it's
it.
going to
Randy and I were trying to figure, we were emailed an estimated number today for 831. We're like, oh, I wonder how they got an estimated number.
Yeah.
But yeah, that's about
It's an
the amount. So that was how we went about it. Any questions?
I'm curious, is this something like how we feel about Post? Would that be kind of across the industry with this fellow retiring?
Well, I don't know if I can speak for, the entire industry. Like I said, there's been some other personnel issues with the firm through time. They've had suffered some asset losses prior to us, so there were some people who were obviously making a decision along, termination lines previous to us and previous to his retirement. But I don't know if RBK has any input on if they're going to be in the industry or not. But we kind of do our own thinking anyway. On whether we retain somebody or terminate somebody.
Wasn't Post on the watch list for quite a while? Seems like.
Yeah, the old days of the watch list. Yeah.
Yeah.
Because Mr. Post left originally, right?
Right.
Now this is somebody different.
Yeah, the namesake is on the door still, but these are different people.
Huh. Okay. Thank you, guys.
We'll be back in October to fire someone else.
Right. The Grim Reaper.
So that's what you call.
Randy, not you, John. Tab 6, right?
Yes, sir.
So, Mr. Chairman, maybe to set the table a little bit for this
Sure.
conversation. Again, as part of the three-meeting strategy, diversifying strategies, this is a bit of a misnomer of a label. What we're really going to talk about is currency management and whether or not there is a sort of what it is, how we're already exposed to it, and then get some feedback from the board as to whether or not it's something we should look at in the future within the diversifying strategies portfolio. So,
John, Steve, welcome.
Thank you. All right, so turning to slide 2, as Dan kind of said, I wish I had called this foreign currency education or something like that rather than diversifying strategies, but the tie-in here is that, 8-9 months ago, we were asked to look at some specific currency strategies that would have been placed into diversifying strategies. So kind of provided a recap of diversifying strategies here and where we're at with that, but today we're not recommending any managers or anything. We're approaching this really as more of an educational opportunity to share some of the things that we've learned at any rate thus far, and as always, happy to answer questions as we go along. So just jump in, because I'm sure it will get a little complicated and we'll probably have some questions. So moving to slide 3. So this is our CAP portfolio currently, and this is all the currency exposure that we currently have. You can see obviously that our biggest exposure is the US dollar, but not an insignificant amount that is a variety of foreign currencies. The majority of that is due to our international equity exposure. So we own international equities, but they're denominated in euros and yen and Australian dollars and whatever it may be. So we're actively monitoring those assets, and we've made a decision at this point at least not to hedge any of that currency exposure. So we don't try to take any of that on or off. based on what kind of currency exposure we may currently have. So given that, any shifts that there may occur in the exchange rate between the dollar and the yen, or the dollar and the euro, that affects the value that we have within our portfolio, because we report in US dollars, we pay benefits in US dollars. So ultimately, I mean, we care what our market value is in the portfolio in terms of dollars, and that's what we're always reporting back to. So fluctuations in the exchange rate, those could be both a positive or a negative driver of returns. And I'm sure you've heard Randy say over the years that, talk about international equities, currency rates may have hurt us this particular go around, or maybe they helped. So over the short term, that can be positive or negative. Over the very long term, we think that, those fluctuations tend to even out, and there is no, you can kind of see it over a broad period of time, that currency isn't a driver of returns long term, but it can be a pretty significant driver in the short term. So
that means what? Short term is what, long term?
So I'm going to hold off on answering a little bit, because I think we get to that a little bit more in the later slides. Because I want Steve to answer that for me. We're going to get there.
Yeah, no one told me that they get this.
Right?
Okay, thank you.
Our prerogative.
Yes, thank you.
For the moment.
Okay.
Case you could be on Meet the Press.
Watch it every Sunday. All right, so turning to slide 4. Who trades currency and why? So kind of to set the table at the very top, central banks determine the exchange rate for a given country. And so there are, broadly speaking, 2 different types of currency regimes that you can have. So you can have a country that has a floating exchange rate, i.e. market forces set the level of the exchange rate. So supply and demand in the market, people that are trading that currency back and forth, just like it would be with stocks. Market demand sets the price for those stocks. So it would be the same type of thing. So you would find that typically in developed nations. The US, Japan, the Eurozone. In contrast, some countries have a fixed exchange rate or a pegged exchange rate, and that exchange rate is typically tied to the US dollar, or it's tied to a basket of probably developed market type currencies, and it's set by the government. So they're controlling what the exchange rate is, not necessarily market forces. That would typically be seen more in developing countries, because they're concerned about their currency fluctuating widely. That could be damaging to their economy, damaging to their country in general, to the capital flows that may happen. So they're trying to put a damper on that and tie it to something that's more stable. So examples of that would be China, Hong Kong, Panama, developing type countries. You've probably seen, maybe on Meet the Press, China and the yuan, their currency, we've been in a trade war here more recently, a lot of talk about that in the news. So China pegs their currency to the dollar, and they set that rate each day. They do kind of let it float in a range, so that it's kind of a quasi system, but essentially the government pegs that to the dollar and controls that. So as we've had the trade war, you've probably seen talk in the news about them depreciating their currency, i.e. they're devaluing their currency, and that makes their exports cheaper, because the dollar is worth more. We can buy their exports less expensively, because our dollar goes a little bit further, and in contrast, it makes our exports to China more expensive. So that's obviously been a lot of the contentious back and forth that we've had in the news. So the way that they do that, kind of broadly speaking, is that China would print yuan. They're the government, so they increase supply of their currency. So an increased supply of their currency, there's more of it out there, it makes it less valuable. And then they go out and they buy US dollars, which drives up the price of US dollars. So they're getting, kind of both sides of that equation. They make the dollar more expensive, the yuan is cheaper. Probably other ways they can achieve that, but broadly that's kind of what's going on. Another example of a government depreciating their currency would be perhaps in the financial crisis. We had a lot of issues in Europe. The euro was having a lot of problems. You probably kind of remember the acronym, the PIGS. So Portugal, Italy, Spain, Greece were all in dire straits in terms of their economies. So there was a lot of concern about the Eurozone falling apart. The euro was falling, it was depreciating, and people within the Eurozone were looking for places of safety to put their money, to protect the value of their money. So they were looking at Switzerland, which is generally a very stable country. So they were flooding into Switzerland, buying Swiss francs, selling euros, buying Swiss francs, and the Swiss are also a largely exporting nation, and they sell a lot to the Eurozone, so their currency is appreciating dramatically. Their exports are becoming a lot more expensive to the Eurozone, and because of that, the Swiss National Bank came out and said, hey, we're gonna print Swiss francs, and we're gonna buy euros to try to kind of even this out and make sure that our currency doesn't appreciate so much, because you're having a dramatically negative effect on our economy and our ability to export. So I'll stop there for a second. Does that make sense? Yes, sir.
So what's the difference between intervention and manipulation?
Your
Say so into the
your point of view. You know, I would say all governments are going to intervene to a small degree, and you can make the argument that you know, changes in your interest rates and things have similar types of effects. We'll kind of talk about that a little bit as well on some of the future slides, but yeah, I mean, obviously we labeled recently China as a manipulator of their currency. They obviously disagree, so, you know, politics probably.
And the story the next day or 2 days after that claim was made, it was clarified that China just didn't intervene. So you can use that in the same sentence to say, it started out as manipulation claim, but they just let it float apparently and didn't intervene, so as a result it actually depreciated.
Right.
So when one country manipulates, the other has to intervene?
They don't have to,
They don't have to.
but
Well,
it gets
no,
kind of
sometimes they're going
it gets to be a downward spiral.
Yeah.
And that's the concern. Because obviously if everybody's doing it, you know,
Yeah.
we're just rushing to the bottom. So. All right, so I'll go on here. So banks would be another big actor in the currency markets, acting as a dealer for their clients or conducting their own proprietary trading. So think of this as, say, State Street, we sell some international bonds, say they were denominated in euros, they're going to, you know, per our direction, they're going to automatically, you know, convert those back to dollars for us, or if we got a dividend payment in Australian dollars, same type of thing. In a different vein, say JP Morgan trades bonds, big bond trader in the market, they trade international bonds. In order to facilitate trades for their clients, they may have somebody come to them and say, well, I want to sell you, you know, an Australian bank bond, and it's denominated in Australian dollars. In order to help their client, they want to do that trade, put it on their books, but perhaps they don't want the currency exposure because they're a U.S. bank. So they might buy that bond and then go out into the market and hedge that currency exposure away while they still own the asset, but they've hedged away the currency exposure.
And how do they hedge the currency exposure?
So there are a number of different instruments that they can use in the market, but essentially you're going, you know, let's say they bought a $1 million Australian bond and they think that they're going to hold it on their balance sheet for a week. They could go out to, you know, Citibank or somebody else and say, we will sell you Australian dollars, $1 million in Australian dollars. You'll give us $1 million in US dollars. And it's a forward contract basically. So they're saying, you know, in a week or in a day, whatever their time frame that they think it is, they can offload that exposure and basically just sell Australian dollars, buy US dollars, and when they sell, essentially when they sell that bond then to somebody else, they just, they're essentially swapping the currency back with Citigroup so that they don't have that exposure anymore.
Is that a zero-sum game?
So it's kind of a zero-sum game with the exception that, well, and I'll get to it here. I don't think it's always a zero-sum game because you have a lot of different players in the market that are doing things for different reasons. So the next one on here would be like a corporation. So think, and this is maybe an easier example, Carl. So think of John Deere. They've got operations and sales all over the world. They sell, $1 million in tractors to one of their suppliers in Europe. They invoice them, they're going to get paid in euros, but the invoice isn't due for 60 days. Okay, so they're not going to get paid for 60 days, but they've got exposure to the euro for that 60 days. So they go to JP Morgan and they say, we want to sell you euros 60 days forward in exchange for dollars, and we're going to agree on that rate today. So we know so John Deere is going to have certainty as to what they're going to get. They're going to get in dollars, whatever they set that exchange rate, whatever that forward contract is, so they can offload that exposure. JP Morgan is taking the risk that of whatever the currency exchange rate could move in that 60 days. And John Deere's stepping back and saying, well, that's not our business. We sell tractors. We don't care about taking currency exposure, and it could work for or against us, but we'd rather have the certainty. So I think you have players in the market that, may be trading for different reasons, and so everybody can win, I guess, at the end of the day. It's a somewhat unlike, in my mind, equities, where you're saying, I'm going to sell this stock because I have a view that it's going down, and somebody else has a view that it's going up. One of these wrong. Not necessarily.
So the banks aren't benevolent in their
They are not.
and stuff. So they're doing it. They're doing.
Oh, I think they are.
They are.
They used to be. But so they're getting. Where's their margin in that?
They take a percentage, of course. It would be similar to, say, a bid-ask spread or something in the bond market, but they're taking a little piece of that.
Is that a fairly liquid market? I mean, would John Deere have to have somebody on staff that could assess whether this is a good rate or not, or is it pretty liquid?
It's an extremely liquid market, and we've got a slide on that next page.
Mark?
Yeah, they probably do.
That's all right.
I think so.
So, remember when, it seems like the same thing, similar to people trading commodities, and used to be you could buy double options, just bet that they fluctuate,
Right.
SEC prohibited, I think. But is it similar, bonds are just not, money markets are not intuitive to me.
I would say it's a little different. At the end of the presentation here, I've got kind of a trade that we'll walk through, which I hopefully will make that clear. Not that that's how every one of them works, but I think it will make clear how somebody would or would not potentially make money on things.
I appreciate that.
Sure.
Steve Johns promised that you're going to answer a lot.
Well, actually, that part is after I'm done, so that goes back to me again.
So at that point.
He's on the hook for that part.
Yeah. So finally, there's investment managers in the market, obviously. Lots of different types, so I'm sure I'm not covering the waterfront here by any means, but active and passive hedging strategies. What I mean by this is I'm thinking of, as we've shown on the prior page, we have exposure to international currency. Some of our peers would have what they would call an overlay manager who would look at their, we download the portfolio of NVDA, they would look at that exposure and they might just passively hedge that exposure, portion of that exposure, all that exposure back to dollars for you, everything. And they're not going to, it's just always going to be dollars. Other overlay managers you could get might be more active. You could hire them to say, well, you have a view on whether or not, we've got our highest exposure to the euro and the yen. So let's say that the active manager, overlay manager says, well, we think the euro is overvalued, but we think the yen is undervalued. They might hedge the exposure on the euro and not the yen, or maybe they hedge some of it, more of it back to the yen because they think it's a good deal. So some of our peers do that type of thing. Many of them don't do anything at all, such as what we do now. But that's something that's out there and in size. Other active currency managers, I mean, probably one is the waterfront here, but we have asset managers that are in international equity. We give them the option to hedge their exposure if they want within their international equity portfolios. Most of them don't, but they have that option. There's multi-strat managers like GTAA who may choose to take direct currency positions within their portfolios if they think there's something to be gained there. There's a variety of hedge fund strategies that would take currency exposure. And then there's managers that would take like direct currency exposure. They don't own an underlying asset. They're simply trading, they're buying the yen because they think it's cheap, and they're selling the Australian dollar because they think it's rich, and they're trying to, catch that wave wherever whenever it may happen. And again, Steve will get kind of to some of the timing of that type of stuff in a bit as to what we have kind of seen now. Further questions at this point? All right, if not, go to slide 5. So benefits of investing in currency, obviously access to markets outside the U.S. If we're investing outside the U.S., we're going to have exposure to international currencies. And even, think about a lot of the large multinational companies that we may be invested in, even if we're invested in a dollar sense. Say Apple Computer, for instance. They have operations that are in, a variety of locations throughout the world. They have sales throughout the world. They, in fact, issue, a lot of debt in different currencies. We actually look at that within the investment grade corporate space when we're considering an investment with somebody like Apple and say, well, do they have a debt distribution that's kind of similar to what their sales and their operations might be like? Because if they're all in dollars and they've got operations in Europe and the exchange rate changes, will they still have to pay their workers in Europe, and they still have to pay their expenses there? And so that could, again, work for or against them. So we would like to see them actually kind of match that up as well as they can, so they don't suffer ill effects from that, those exchange rate moves. And they try to do that, most of them. They will be cognizant of that. It is a highly liquid market, Terry, so average daily trading volume of $5 trillion plus, as opposed to $84 billion for equities. So huge liquid market, trades very regularly in kind of a lot of standard formats, very easy. When you talk to some of the managers, you ask them, well, if you've got an exposure, how quickly can you take it off? It's like, well, I can pick up the phone and I can do it almost immediately. The treasury market trades with a volume of like 500 billion a day, so it's a huge, huge market. The last 3 points here, again, we're going to talk about this a little in the ensuing slides, but currency returns are not generally correlated to other asset classes. The currency markets aren't necessarily efficient. They do deviate from their fundamental value, and Steve, again, is going to tell you all about how we get to fundamental value for currencies. And as we noted before, I don't think it's necessarily a zero-sum game, because you do have different participants trading for different reasons in the market. And finally, we do think there's opportunity to earn returns potentially from changes in the exchange rate and the interest rate differential that occurs between countries, i.e. the U.S. has a higher rate, say, than the Eurozone, and that enters into the exchange rate discussion here. So if there's no other questions at the moment, since I gave a big build-up for Steve, you better deliver.
Well, thanks, ladies and gentlemen. Happy to be with you again. So starting on page 6, we're going to talk about the concept of purchasing power parity, PPP, if you will. So the way to think about this is you might compare it to yield spreads in fixed income, or you might compare it to PE for equity or whatnot. Basically, it's the valuation metric that we use to gauge long-term values in currency markets. What does it mean technically speaking? So this goes to the idea of the law of one price, which is after accounting for exchange rates, you can buy the same things in any country for effectively the same price. So we talk about a basket of goods, and so we have the charts down here at the bottom with a tasty looking basket of fruit and eggs, and I think there's a pineapple in there, which I kind of like the idea of. So after you make your exchange, you should be able to buy approximately the same thing, or buying that same basket of goods should cost about the same thing. We've got a chart here showing an example between the US dollar and the pound. It would cost you theoretically $1.31 to buy that bucket of stuff in US dollars, whereas only one British pound even in the UK to buy that same basket of goods, because that's what the exchange rate is. As tends to be the case with things in finance, we make some assumptions that in reality don't always hold, but you have to start someplace to have a discussion of it. So some of the assumptions that we make in terms of PPP are that transaction costs are zero, there are no barriers to trade, and there's no difference in goods between locations. Again, we're going to discuss coming up in the following pages how those don't always hold, but that's our starting point for analysis. So I would direct you to the next page, where we're going to take a look at perhaps the most famous example of purchasing power parity, which is the Big Mac Index. You can buy a Big Mac pretty much anywhere in the world, as it turns out. I'm not sure if they exactly all look like that picture right there, but we'll assume for the sake of argument that we do, because otherwise we're having to relax that thing about no difference in goods between locations. So what we have here is these prices in various countries have already been converted into US dollars. So the various exchange rates between the US dollar and other countries are already taken into account. So what we notice right off the bat is it looks like purchasing power parity does not hold, because if it costs $5.58 for that Big Mac in the United States, why is it not a comparable version in foreign currency of $5.58 in other countries? This is where we talk about short run versus long run, and the fact that some of those things that we talked about don't always hold in reality. But we just kind of want to show this as an example of, theoretically what it would look like. But again, we're going to talk on the next page in some more detail about why it doesn't work. But I guess we also kind of wanted to get you hungry for the barbecue later on. So there's your graphical illustration. Next chart, very importantly. So why is it, in fact, the price is different from fundamental value? Why is it, in fact, that a Big Mac does not cost exactly $5.58 US dollars in every country? Why is that? We've talked quite a bit already about central bank intervention, and that is probably the number one reason, especially for regimes that try to maintain a fixed currency rate. Turns out central banks tend to have a lot of power in the world, and so if they decide they want to monkey with the exchange rates, that's going to monkey with purchasing power parity. Monetary policy within a given country is probably the second biggest reason. So what we're talking about here is basically the carry trade. Countries that have higher interest rates generate more demand for their currency, and therefore their currency rate rises. John kind of alluded to this with the Swiss franc example earlier.
So curry, what comes from is people want that currency, they want to carry that currency. Is that where the curry?
Because they want to make a higher interest rate.
Yeah, that's where the carry comes from.
Yeah, I mean, you could, again, we're going to have an example that, John's examples are coming up, but I'm probably making this too colorful, but it's like you're making a loan here and carrying your dollars over here and investing it where the higher rate is, right? So like if you want to, here we're back to the basket illustration again, except this time it's a basket full of money or whatever it is you're you're carrying to the bank.
Steve?
Yes, please.
Yeah, go ahead. No, go ahead. I was just
No,
kidding.
I was-
kidding about one, he had one metaphor. I was gonna.
Oh, I'm sorry. I didn't know I was subject to the metaphor.
Jim's not here. You can compete with RDK.
We were metaphor-free today.
We're using it up.
I'm sorry, Steve.
That's okay.
Except for the ship one.
Yes, please.
Except for the ship one.
That's true. Yeah, sorry.
Excuse me. Go ahead, Mark.
You said the country with the higher rate
Interest rates.
has tell me what
So all else being equal, if your country has a higher interest rate, there's going to be more demand for your currency because people want to invest in your country. But, you know, if you're coming from Japan and you want to invest in this country, you have to buy dollars first before you can do it.
Sorry.
Yes, sir. Okay. Just a bevy of other reasons here that can cause PPP to get out of whack. Inflation, trade imbalances, tax differences, political risk, consumer preferences, manufacturing and transport costs. So basically, these are all the things that happen when we come to the real world and loosen those pie-in-the-sky theoretical assumptions that we started with. So we're going to give an example here of the US dollar versus the Australian dollar exchange rate. I would draw your attention first to the blue line, which is the graphical representation of purchasing power parity. Assuming that those prices are relatively equal, you might think about it as kind of the long-term average exchange rate. And you can see that especially since about 1990, that line has been remarkably stable, all things considered, especially thinking about how things jump around in the world of finance. To have a line that is more or less flat over 20, 30-year period is pretty amazing. The blue line representing, again, long-term purchasing power does not vary very much. It does not vary very fast. In contrast, we have the red line, which represents the actual exchange rate in the short run, which obviously moves around a lot more. It's below the line, it's above the line, it's way above the line, it's way below the line, but importantly, you'll notice that it does always tend to kind of converge back toward that average line. It does not indefinitely and forever shoot off in one direction or the other.
Pretty long cycles, though, actually, at least on this.
They can be, they can be.
What was that question?
She's commenting that
Pretty long.
the cycles can last for a fair period of time. For example, if we...
Isn't it, now I get that, I'm sorry.
Yeah, go ahead.
My question was,
Yep.
doesn't it have to follow the blue line by definition?
Of course, yeah. But I guess to my earlier point, the fact that maybe I should have stated it this way: the fact that the blue line does not indefinitely go off in one direction or the other illustrates the long-term stability of it. Yeah, you're right. If it just kept shooting up, then so would the blue line, right?
It seems like if it's an average, it's an average.
Yeah,
but,
right.
So it's kind of your short-term, long-term comment before. I mean, the blue line is the long-term, the red line is the short-term, but the short-term isn't all that short necessarily, as you pointed out, so.
But we're going to talk about, on the next page, if I would have you flip over there, we're going to talk a little bit more about long-term and short-term. So again, as we just commented, exchange rates do tend to revert to their fundamental value as defined by PPP over time. They do swing around the central axis, but they do head back toward it at some point, again, by definition. Here we have a selection of currencies demonstrated on here: dollar, euro, yen, Australian dollar, Singapore dollar. Looking at 100 as kind of being the average value there, you can see that they swing around it but come back to it. To our comment here about over a shorter time frame than other asset classes, it varies, but probably about 3 to 5 years on average from the time that one of those colored lines departs significantly from the straight line 100 index in the middle until they come back to it. 3 to 5 years might seem like a long period of time, but I would compare that, for example, to in the equity world, if you think about growth versus value as styles, for example, value has been out of favor for the better part of a decade. So 3 to 5 years in terms of something coming back to normal may not be all that long after all. And it turns out if it's a short enough period of time for good currency managers to be able to take advantage of that.
Yes.
Did you see any evidence of an acceleration of coming back to the norm as it's more traded, or are there any factors that seem to be changing that market?
Not that I'm aware of. Next page. So here we're going to talk a little bit. We talked briefly earlier about reasons that investors might want to be in currency. Again, this is for educational purposes, not advocacy purposes, but we do want to talk about some of the reasons. One is relative lack of correlation with other asset classes. This is just a very simple chart showing dollar spot rate versus the S&P 500, which is perhaps the best known equity index in the world. There are periods when they align, like the late 90s, but pretty much everything was going up in the late 90s, so I suppose it's not terribly surprising that they were both headed up at the same time. But that is not always the case. What happened around 2000 when we hit the tech bubble, the S&P 500 there did trail off pretty significantly starting around the early 2000s, whereas the dollar index continued to rise for some period after that. Then around 2003 there, when we started to have a recovery in the stock market index, that was the time that the dollar started going down. It continued to fall down into the late 2000s while the equity market continued to rise. Then they kind of converged again a little bit there in the early 2010 period, and in the most recent 5-year period, you can see they've kind of gapped out again. So the idea of diversifying your exposures, not putting all your eggs in one basket. I'm sorry, I just realized I used another metaphor. I think I'm going to get fired next. That's certainly one of the reasons that you would want to invest in currencies. Next page is volatility dampening. This is another reason that you might want to invest in it. So if we look back to the late 2008 period there in the dark blue line, that is the VIX representing stock market volatility. You can see that reached levels not seen anytime recently before or since. You can see that the medium blue line there in the middle is the currency volatility. Did rise, but not nearly as much. And in all the time since then, there have been numerous smaller spikes in the equity market, but not near as much in the currency market. So again, volatility dampening your overall portfolio volatility is another reason that folks may want to make a currency investment. And the final reason that I'm going to present to you is, on page 12, downside protection. I think the equity market behavior in Q4 of 2018 is still pretty well fresh in everyone's mind. You can see here we're using the ACWI index, so that's a global equity index including both US and international equities. Fell off very sharply heading into the end of the year. In this case, it is the green line, which represents the dollar index, basically held its ground. Holding your ground might not seem like that great of a thing, but when everything else is off 10% or better, holding your ground doesn't seem so bad after all. So again, downside protection, hopefully exactly when you need it, would be a third major reason that folks would want to make a currency investment. So again, that's not meant to be advocacy so much as it is to be explanation of why you would want to do it.
So are there, when I look at this downside protection, I'm guessing this is, it says basket of currency, so that's kind of an aggregate. Are there currency funds? Is that what, can you go buy one that should mirror this, you know, like. the
Yeah,
S&P.
I believe we mostly looked at this in terms of individual managers. In fact, this was one of our managers that we had spoken to over the last year that provided this chart for us. Are we aware of there being currency, there's currency ETFs and things of that nature, are there not? Are we off base on that?
I don't know if you could buy, I wouldn't be surprised if you could buy an ETF that would mirror the basket.
Okay, yeah.
That's probably
Yeah.
likely.
Yeah, and I think that's what I think that's more to the question here is like,
You could buy an ETF
Yeah.
that would mirror, you know, this DXY, yeah. That's not really what we were looking at previously,
Yeah.
so we talked more to managers who would
yeah,
have a view on, you know, particular currencies one way or the other.
yeah, I suppose that, you know, if you wanted to go the passive route or however you want to characterize it, it wouldn't do much good to show you a chart like this and say, well, we can't actually do it, so, you know, it's very theoretical and pie in the sky,
If
so.
I got the recession coming, what do I do?
Of course, the trick is to predict that, you know, the starting point there and the ending point, but, you know.
Bruce?
Yeah, I'm just curious with my farmer hat on here, when, on your chart on uncorrelated to other asset classes, at least some commodities, particularly the one I'm involved with a lot, wheat, seem to be directly related in a counter-cyclical way to the value of the dollar. When you look on the chart, when the value of the dollar spiked 2014, 2015, that's when our exports of agricultural commodities and possibly other commodities that are heavily involved in the export market tanked. So would that be one asset class that might be a little bit more related to the fluctuation in the value of the dollar? Or am I just making that up?
No, I trust your experience in this area. I guess, you know, we looked at it mostly in terms of, you know, stocks and bonds, basically. I guess that, you know, again, just going by your experience, I think, you know, it could be true that commodities have some higher correlation to the dollar. In fact, I think that probably is logically true.
So it makes sense because if the dollar's going up, getting more expensive, it makes exports, which we would be a significant export, more expensive for others to buy that commodity.
And not that in the big picture this isn't worth looking at doing, but again, with my farmer hat on, that just kind of got my attention there.
I think as John said, that kind of goes to the idea, and maybe to tie it back to PPP again, you know, if it's, you know, more expensive for the, you know, other country to buy that, I'm gonna get myself in trouble.
Well, there is a commodity that's only valued in dollars, and that's oil.
Right.
Yeah.
And that's been a long-term debate, discussion about whether that should actually continue or should it be a basket of currencies, but that is one that's actually only valued in dollars.
True.
Mark?
I'm still wondering about this page 11, because I'm comparing that with 12.
Yep.
This one's, just because I'm having trouble understanding the graph.
Okay.
When you say, is that measuring volatility, or is that measuring value and showing volatility?
So page 11 is showing volatility, the indexes that measure that directly, the VIX, CVIX, TIVIX, those are actual measures of the volatility measure as opposed to value measure.
The peak there indicates a wide fluctuation in.
So this is the same thing that Mark and Becky were talking about with equities when they were talking about volatility before, just a different graph of the VIX, so they're talking about the spikes at different times.
Whereas in 12, we're looking at value, correct?
Yeah, this is yeah.
Right.
Correct. These are actually indices as opposed to measures of volatility.
Okay.
Okay?
Okay.
Anything else from anybody up to this point? All right. All right,
John's back on
John?
All right,
with his awesome charts.
so we'll try to walk through kind of a basic trade here. So this slide 13, this is kind of a representation of the carry trade. It's how it essentially is how it would work. So if we start at the top, at the beginning of the period, so the beginning of this year, the exchange rate between the dollar and the peso was $1 buys you 19.65 pesos. And if the one-year deposit rate for the US is 3%, and the one-year deposit rate in Mexico was 8.5%. So obviously a much higher interest rate in Mexico. So if we wanted to do the carry trade, we could take our dollar, and I should say, so currency trades are generally thought of as kind of a pairs trade. So generally you think of it as we actually borrowed a dollar and we went and bought the peso, another different currency. So we borrowed a dollar, we're going to go buy the peso, we convert that dollar to 19.65 pesos. We go stick it in the bank in Mexico for a year. We earn our 8.5% interest. At the end of that, we get back 21.32 pesos. And then we're going to convert it back to US dollars, because that's where we're at, that's what we care about. So then we got to look at what's the exchange rate then at the end of the period. So in this first example, I said, okay, the exchange rate didn't change. It's exactly the same as what it was. We convert back to dollars. We end up with $1.08, so our 8.5% interest. We need to subtract out our 3%, which was our financing cost for buying the dollar, or borrowing the dollar. We could think about that if say it was our dollar, because it was kind of an opportunity cost type thing. We could have invested it for 3 cents, and so we subtract our 3 cents for our financing costs. We're left with $5.50, and so we made 5.5%. Pretty decent trade relative to what we could have realized in the US with our dollar. So if we then look at slide 14, exact same trade, we're doing the exact same thing, but in this case, over the course of that year, the dollar weakens or depreciates versus the peso. So i.e. the peso got stronger versus the dollar. We go through that same thing, we get 21.32 pesos at the end of the year in Mexico. We go to convert back to dollars, but now it only costs us 19 pesos to buy a dollar. Before it cost us 19.65. So we end up with $1.12 and change. We subtract our financing costs and we end up with $1.09. Awesome, great. We could do that every year if we can make that work. We'll do it. But sometimes it doesn't work as well. When we turn to slide 15, if the dollar gets stronger or appreciates versus the peso, or the peso weakens, again, exact same trade. We get our 21.32 pesos, we convert back to dollars, but our exchange rate now is different. It costs us 20.3 pesos to buy a dollar. So we convert that back, we end up with $1.05, subtract our financing costs out, and we end up with $1.02. So that's kind of the basics of the carry trade and how you can, why you care about interest rate differentials in countries, which kind of to bring that back to the purchasing power parity. This trade shouldn't exist. This shouldn't happen if purchasing power parity worked, but it does work, and people have been doing this for decades. I mean, think of the Japanese yen was the traditional, borrow the yen because interest rates were zero there, and put it in almost anything else over the years and do the carry trade. Now, there's periods of time where you got killed on that occasionally, but a lot of times that was a really good trade. So currency traders have been doing this for a long time. I'm simplifying this a little bit, so there's a variety of contracts out there that people would use. You're not always going to a bank and doing that. You're going to the bank and just agreeing on a forward contract with them. But all the same principles apply. It's oftentimes a shorter, it's a 1-month forward contract, similar to oil commodities and various things. And you roll those contracts each month. But again, they're extremely liquid. If any given day you want to, take this whole trade off, you can do it right away. So, any questions on that? All right. Well then, quick summary. We have existing exposure to the currency markets. It's a transparent and liquid market. We think there are some diversification benefits to consider for currency, and believe that some investors can take advantage of inefficiencies in the currency market that tend to persist over time. Happy to
So
answer
how
any
would we, if, I mean, I know you're not, this is education, it's not proposing, but how would we do it? I mean, would you be doing it? Would you be going to Mexico and buying the dollar?
We're sending to Moscow.
No,
And not the nice part either.
Right, how do you, I mean, how do you do it?
We would hire a manager, clearly. We looked at a pretty narrow subset of what you would do in the currency space. The direction that we were given was kind of, in the context of diversifying strategies, how would you diversify away from equities? The types of managers we looked at would take kind of a direct currency, just take the currency exposure, unlevered, reasonably low returns, low volatility returns, but over a decent period of time, they kind of return kind of mid-single digits. So it's nothing that was gonna, we're not gonna meet our actuarial hurdle with that type of strategy. But it's a diversifier. So that was the main thing that we looked at, because that was the direction we were given. There are certainly other things like the overlay type managers that could be passive or active, and those are things that we can consider in the future, but we haven't really looked at that closely at this point.
Okay. Becky?
Most of our clients don't have a standalone active currency manager that's just there to generate alpha. It's extremely difficult to do over time. Although it doesn't look as volatile, it's very hard to hang on to something that has some of the characteristics that currency does. So where plans typically start the conversation is, do they want to change the currency footprint they have? So think about an insurance company hedging its bets, or a farmer hedging the crop that they're bringing in. A pension plan would look at this and say, we know we have to pay our beneficiaries in dollars. Do we want to convert some of the non-dollar exposure we have to dollars so that we remove that uncertainty at a price? That's a protective overlay kind of strategy. There are managers that do that. They assess what kind of overlay program you would need to meet the kind of currency protection that you want. From there, you get managers...
Can I interrupt for just 1 minute?
I'm sorry? Sure.
How do you decide, I mean, is there a threshold? I mean, how do you take a chart like page 2, is it? 3?
Yeah.
I mean, and...
Non-US.
Is that what it is?
Yeah.
Oh, yeah, that'd be 82 months from...
Right.
That'd be the way to do it.
Right.
So,
Yeah.
is there a number?
Plans will differ. Like, for example, one big state plan that I worked with actually read a white paper on removing volatility that was attributed to currency that State Street had put out 15 years ago, maybe 20 years ago now. And they recommended a hedge that you kept on all the time to remove volatility if that was a concern in the plan. And so it was a 75-25 mix, I believe, that they recommended, hedging away 25% of your currency.
No, but my question is it 82 in dollars and 18 in foreign? Is that, I mean, is there 75-25 there?
Well,
or is it just any?
Any mixture. They would take that 18 and hedge away 25% of that exposure and keep the rest. So that's one thing, is it's the view of the plan sponsor about whether they should do that on the whole plan. Many plans have managers that will, as was mentioned, defensively hedge against currency if they think it's a good time to do that. They can do it in an international equity portfolio. If they like a Japanese stock but they don't like the yen, then they could actually put on a currency trade. A lot of international managers aren't very active in currency. They understand that their clients are buying the whole shebang. They're buying the security and the currency that was purchased in. And in some ways, there's diversification by having yen in your portfolio along with the security itself. They may make a top-down decision saying, because of my view on the yen, I don't want to buy that Japanese security, so that's what we call a natural hedge, where they just avoid the exposure. Because there's a tight correlation between, as you've heard the explanation, between currency and fixed income markets, or currency and cash markets in those countries, a lot of times you'll see non-US fixed income managers hedging back to the dollar. So that's part of the strategy they're selling you. So first of all, you realize what currency exposures you have. The second step is you decide whether you want some kind of protection from the currency exposure that you have. If you don't, then the next level decision is, do you want to hire managers that are active within their international equity mandates or non-US fixed income mandates to hedge and not do anything on a total plan basis? And then the next option is, if you don't want to do any of that, do you want a manager who's going to try to move among these markets and try to make money from currency itself? And it's the latter that we don't have a lot of clients doing at this point on a standalone basis. Sometimes this is included in GTAA strategies and in managed futures strategies and in hedge fund strategies as another way to try to earn alpha without having a long-term exposure in a single asset class. So a tactical oriented strategy. And it's valid. It tends to have all the characteristics that were laid out to you. But in terms of, are a lot of plans doing this? Not necessarily. This is one of those things that you can find if you want to try to make money from active currency management. Yes, there are managers to do it. But it isn't, because of the comment that was made about this being a zero-sum game, if you're just looking at the values of currencies over time, we really don't think that that's necessarily something that would, in fact, in our asset allocations, we assume that currency is a zero-sum game over time. It would really take this kind of approach to differ from that long-term premise.
So Becky, one of the things that farmers like me get in trouble with is crossing the line from hedging and speculating.
Yeah, that's an important distinction.
So, I mean, where are you talking in the mix of that?
Yeah.
Because it seems to me, we know we have risk on 18% of our portfolio that is in foreign currency.
Right.
And
which is smaller than most other plans.
And there might be a legitimate interest in us looking at hedging part of that. But some of what I just heard you talking about there sounded more like speculation than hedging, which, at least for us farmers, is dangerous territory.
Well, true hedging is the overlay that I spoke about, that takes that 18% and then takes out whatever portion of that you don't want to have remaining in foreign currency. That is protective hedging.
And that just takes it out?
Yes. Yeah. So they will just buy the dollar. They'll sell exposure at a price. At a price. That is protective hedging. That's what Caterpillar does, and that's one of the other arguments, is that when you're looking at buying company securities, they're doing this for themselves. When I worked at an electronics manufacturing firm, one of the things that I did was to buy yen exposure as part of my job. And then part of what the firm's treasurer did is try to negate all of our non-US dollar exposure where we didn't want it. That was protective, all protective. Speculation is a tough word because it brings to mind all kinds of risk-taking. That could mean leverage. That could mean, say a manager, you've told a manager, protect me against the yen, and the manager goes and buys another currency because they think it will be a better deal to help you hedge against what happens to the yen. So that's cross-trading or cross-exposure management. So certainly when you look at ways to manage currency, I think you have to, one, establish if it's going to be protective. Is it about the 18% or not? If it isn't and it's a source of return, do you have enough confidence in the source of return by what the manager's going to do?
And you're
That's the
saying
real
that
question.
that people don't do?
A lot of plans aren't going that direction. There's enough other betas that they're buying in their portfolio to give them diversification, that they're doing more real estate, they're doing more fixed income of different kinds, maybe they're doing commodities. But it is something that's out there and available in the marketplace.
Right.
And it doesn't mean, because not a lot of folks do it on a return-seeking basis, that it isn't the right thing to consider. It's just simply another tool that you could use. Whether or not you're comfortable with it, just know there isn't a lot of institutional following in the public pension plan world. But it is an option, and it is more of an exposure if you look at multi-strategy funds. Currency can be a part of it. It's just rare to have it on its own. We've had a couple of clients that have had an alpha-oriented currency mandate, and they both terminated them recently. And just ironically, they terminated them recently, and sometimes they were combined with a protective overlay strategy and an alpha. But the frustration in one of the clients I worked with was just, it wasn't producing attractive returns. It was a disappointment. That doesn't mean that yours wouldn't be. But it's one of those strategies that's going to be a very small consideration, probably. And if you're looking at an alpha strategy where you're trying to make money, you would actually buy more non-US exposure to do this. It wouldn't be a protective where you're selling some and then trying to make money too.
And then, oh, I'm sorry, go ahead. Well, on the protective one, it almost sounded like you were saying that you hire someone, they come in and they tell you when you need to be protected.
They do it for you. They actually look at your whole portfolio, and they would enter into the trades, or to tell you what to do. You could implement it too.
Right, but I'm saying, so they may look at this right now and say, there's nothing you need to do. And then next week they'll say, oops, we've lost confidence in the Hong Kong dollar, so we need.
Yeah, they would just look at your portfolio and say, you have 3% in euros, so we're going to net out that 3%.
To the US dollar.
And
We're just going to
change
sell
the
all of
rate.
that 18%.
Exactly.
Okay.
We're going to enter future, however they implement it, and then if your managers shift into 4% euros, they're going to hedge a little more of the euros. All they're doing is negating your currency exposure outside of the U.S.
But how are they deciding? Are we setting the parameters by which they're doing
In
that?
that instance, yes.
Yeah.
You're
And maybe
saying-
you say you want 100% US dollars, and they'll just keep adjusting the portfolio based on what your managers are doing to have that 100% dollars. But
Right.
Yeah.
And how do
There's
we?
there's a lot of ways they can do it. Yeah, so it could be driven by us, it could be, I mean, managers might do it 100%, they might do it 50%, they might do it based on what we wanted, we might, you could give them total control, and they would make a decision that something's over or undervalued, and you would just hands off. So I mean, they're exactly right. I'm just saying there's all kinds of ways you could do this. It would just be whatever whatever our comfort level was. And again, not suggesting that we're doing any of this, so.
Right, but I'm trying to get to the point of if this is set up for asset allocation, part of that has got to be, well, how do we make that decision? So how is it that we decide, do we want to give this all to somebody else? Do we want to say it's 50%? Do we want to say it's 25%? I mean,
so I don't think we're there yet, I guess is my short answer. I mean, I think we have an asset allocation proposal that we need to make in October.
Right.
That you then need to consider. That may or may not include something like this. But in my mind, we're not ready to make this decision.
well, I'm not trying to make
or
sense. I'm trying to
put it into
ask
asset
you, what are
allocation.
how do you even decide? Crystal ball. Is that it? It's just a crystal ball?
Well,
I think it's, what are you trying to accomplish?
There's a white paper that says 25%, the white paper that they came out with, right? 25% of 18 in our case, or 25% of 30.
Well, but don't you just look at the historic, excuse me, I'm sorry.
Yeah, but I mean, it isn't a science. I mean, they came up with a white paper that said if you want to do what we think you should do, our best
Yeah.
regimen is slough off 25%, take it out of, in our case, we have 18% foreign currency, and the only expert testimony that I've heard today is the State Street white paper.
And that was years ago, and this particular plan either started at 75, 25, or went to 50, or the paper was 50-50 and they went to 75, 25. So the paper actually looked at risk and return.
Okay, so-
Carl's point is, how do you know 75% goes to what currency? How do you know which currency?
Hedging out of the foreign currency and into the dollar. So it's getting to your home currency.
Into dollars.
Yes.
Dan?
So there's a number of decision trees here. So first, are we going protective within a currency strategy, or are we pursuing alpha within a currency strategy? We have to make that decision.
Or doing nothing, which is what.
Or doing
Yeah.
nothing, which is what we're doing now.
Right.
So if we go protective,
But we
that's
made
where
the
the
decision to do nothing.
Yes, well, all of your structures have been assuming unhedged.
Right, but we made that decision.
Yes.
Okay, so it's not like we're not, it's
No,
not like we're ignoring it. we're
Not
doing-
changing it. Doing
Right.
nothing's the wrong term, not changing the current
Right,
paradigm.
right, okay.
So then, under the protective decision, changing to do nothing, then that's where the question of 75, 25, 50, 50, 100% comes in. Under alpha, it's how do we hire somebody to go capture the ups and downs in between the average to get us some sort of return. So multiple types of managers. What this conversation was meant to stimulate was whether or not a currency strategy is something the board may be interested in over the longer term, whether or not we want to revisit the decision that has been made of do nothing.
Okay, but that's not, I just want to say, I don't think that's quite right because we have a currency strategy. And the currency strategy is that it's a zero-sum game and it doesn't make sense to be monkeying.
Correct.
Right?
Correct. That's
And
the
we-
strategy you're pursuing.
And we talked about this. We've talked about this. Never in this depth, but we have talked about this before, and we decided that it's a zero-sum game, and we didn't make sense to do it. Now it's a question of, okay, is it or is it not, and does it make sense to do it? I get that, but keep saying doing nothing sounds like we're ignoring it,
Right,
and we're not.
right. Correct.
The fact that we have multiple currencies that we're in and they're relatively similar amounts, in a way, are we hedging because we have the multiple currencies and presumably they're behaving in different patterns?
To some degree, that's
So,
probably true.
you know, I would be much more concerned if I saw we had 15% euros.
Yeah.
But
Agreed.
because they're relatively similar, we may actually, at no cost, be accomplishing what we want.
Or
Is that a theory?
we could test that.
Yeah. Actually, you know, having that additional exposure. Diversification.
Jack?
But if you, the way I see this is, if you think this is not good, the way you solve it is we do less international stuff.
But
That would be a,
but doesn't that?
that would be one way to do it.
The question I have is how risky is it, you know, to do this? That's really what, I mean, if you have a plan that you're gonna say, well, right now, this is what our status quo is, and if we were to go and hire a manager to do some certain portfolio, I mean, if it's so risky that you could actually lose money on a deal, which is kind of the way it strikes me, it's pretty obvious why we're not doing it. But if there's some comfort level that you can hedge it both ways and do some, you know, like double options or whatever it is they do with currency, then it'll give you a rate of return that's somewhere between, you know, this percent on a 90% average. That would make sense, right?
I mean,
Well, you're saying that if it's a guarantee. we should
Well,
do
but
it.
this looks inherently, it inherently looks risky.
Well,
If
and
we just start betting on which,
one of the things that haven't talked about yet is that the fear trade. When the world is falling apart, people buy dollars. So when the world is falling apart, people sell the stock market, they buy dollars. Does that help you? Does that help you as an investor? Does currency really protect you? At the end of the day, it went the other direction because people are afraid, as opposed to a fundamental difference in value. So that is driving some of the data on some of the equity market drawdowns. Is the US dollar went up at the same time that the equity markets went down because investors got scared and they went and bought dollars. So there are other reasons the currency markets get moved other than investors. It's also a fear trade too.
And to sort of on the protection realm, not the alpha seeking decision, but on the protection side, you've got to have a conversation around scope. How big is the participation we may be willing to put into this? So right now, the entirety of the diversifying strategies as of today is 1.42% of our entire cap portfolio. Going down potentially to a smaller number. How much can we put into a currency manager to protect us against the other 91% of the portfolio in a downside? And is that diversifier enough of a value add to warrant all of the staff time, all of the other components that come with it?
Yeah, that's a good question. And that was the first, tried to be the first question I asked. Who would do this?
And not to muddy the waters, but you can actually buy a hedged index too. So if you decided that you wanted international equities, but you didn't want the currency, you could actually buy a hedged version. That's one of the cheapest ways to remove currency exposure. It's not going to earn you any money additionally, but it actually removes the currency exposure to the protective part.
So you buy an international
Hedged index.
hedged index.
Yep.
And, another question that I feel like hasn't been answered is, are you uncomfortable with this positioning to begin with? You don't, just looking at these numbers, you don't have, I don't know if you can answer it right now, you don't have a tremendous amount of foreign currency. Is it worth paying, even if it's a small amount on an index, to hedge something away that in the long run is not expected to cost you anything? It could in the short run, but in the long run is not expected to cost you anything. If the answer is yes, then look into hedging. If the answer is you're not uncomfortable with this, then, I
Well, that's why I asked the rule of thumb question that you.
Yeah, this doesn't seem like a lot of foreign currency exposure.
That's not a fair question asking, but to you, do you think it's worth hedging?
I don't think we've done enough research to answer that question knowledgeably, because that's not what we looked at previously. Given what we know, I think there's some attractiveness to looking at, somebody who would potentially do a little bit of this more, and I would think of it more as the overlay type strategy, but I went into what we started looking at very skeptical, didn't think it was going to pan out. I think we did find a couple managers that could do it. I completely agree with kind of Dan's comment about, would we ever do it in size enough to matter and all those types of things. I don't really think we would, so I don't know that it is a great fit. So there's just some other things out there that I guess I need more information on at this point. It seems like some of them had some skill in being able to, say, hey, this currency is overvalued or undervalued. Not to make it more complicated, but I think I know that there are plans out there that will do things like say, well, we don't hedge most of the time, but when we see something get so far away from what they consider fundamental value, then we'll put the hedge on, so it's only a periodic type thing. Again, I'm not saying that we're going to do that, but those things are, I guess, in my mind, worthy of thought and a little bit of research also being cognizant of, staff time and our ability to work through some of those things. So, do I think this is like a huge problem right now or something? No. No, and I think your comment about them being kind of reasonably equally weighted and probably offsetting each other to some degree is very valid, so no, I'm not concerned about it. It doesn't keep me up at night that we don't currently have anything like that.
Given that, oh, go ahead.
Yeah, question. We sort of veered over, and I guess we're not clarifying to the protection side of this question. Like, if you go back to page 10, it seems to me one of the things that that needs to be part of the discussion is in the alpha seeking, there's also, if you're thinking about this in the diversifying strategies category, there's this correlation issue, or lack of correlation, which is provide some benefit, even if it maybe doesn't add a whole lot of alpha.
Yeah, I think it's just sizing. Sizing is probably the issue there. I mean, could it ever be, would we ever take a big enough position in something like that to really offset the 95 or 96 or 97% of the rest of the portfolio? I don't think so.
Isn't it, it's not so much, from my point of view, it's not so much that that one piece of it is big enough to offset the other 95, but it's one of 10 pieces that offset.
Sure.
60% of the other 95.
But in some ways, we have that by having international equities too. Or any kind of international asset, whether it's equities or something else. Any exposure we have there provides some diversification benefit. And that's a bigger bank than a fund, right? So we've got 18% of the portfolio in international assets. That currency exposure is a bigger diversifier than a manager that would only do currency.
Thank you.
Good, you're welcome. Stimulated some discussion.
No, that was great. I appreciate it very much.
It was interesting.
Good, clear discussion of really
Right.
complex subjects.
Right, thank you very, very much, John and Steve.
Learn something.
Yeah. So can we go to something more definite, Lois? Tab 7?
Tab 7, thank you, Mr. Chairman. Members of the board. Wow, that was exciting. Nice job. Very nice job. Hard act to follow. So all of this talk.
You want to get back to the bumper trucks.
Bumper truck, what is that?
That I understand.
Well, all of this discussion about the market, I mean, we're looking at the program is that we remarket our bonds every year. So there's a flattening of the yield curve. I mean, there's things that are happening. So how I feel about it, I look at this conversation we just had today, and I think the market just jumped on the down cycle and just ran my program right over. But I think we're going to be fine. And the reason why I'm saying this, I see this confused look on her face over here, is only because when we're looking at flat yield curve, my borrowers out there are looking at a long-term that is almost the same interest rate as my short-term variable. And so I have banks out there that borrowers that are going to keep the money in their county by going to their local bank and locking in on long-term.
Yes, I was thinking, we're going to have a lower rate, will be more attractive, but
Yes,
what
we
you're
are.
saying.
Yes, we are. We do have that coming though too. Because we have, with the different tax laws that came up, I've heard that corporations will be looking for a place for a tax exempt place to park their money for short term. So we will have that. It's just the borrower part of it. So we've been having some payoffs. When we're looking at the activity summary, you'll see that our commitments are a little bit lower this year than usual. I mean, this year we had a total commitments of 23 million. That's below average for us. So it's a little on the other side. Fundings are close to average, but I'm trying to look ahead. I'm looking ahead.
So depending on how our commitments go, I don't know, we might be looking at redeeming one of our bonds a little bit early, or just part of it, just to make sure that we don't have too much cash out there. And it also depends on if we have, the commitments are lower than the cash that we have, then we are required by the indenture to pay down those bonds by that amount. So we'll just see, we'll write it out. Something I've always learned with packing horses is that you don't panic. You watch it happen and then you clean it up. It's not a big deal, not a big deal. So, some good news, Savannah has accepted the position for the bond program officer, so she's in a training assignment. Something that we like to do here at the Board of Investments is to encourage growth internally, and so she's taking on that training assignment. So with that, with the activity summary, was there any questions in regards to that other than what I've already pointed out? Okay, seeing none, we'll go to the staff approved loans. Any questions in regards to those? A couple of loans there for the quarter. All right, and then annually we provide kind of a loan concentration. The very next page you have that memo that shows the loan concentration comparison between fiscal year 18 and 19. We also have the lineup of loans that have outstanding or commitment remaining report that is along with that. And I just want to point out on the third page of that report, looking in the Flathead County section, on the very top, I inadvertently added in Flathead Valley Community College numbers into the Flathead County Water District. That little water district, there's no way they can have that kind of outstanding. So the Flathead Community College, that 2.4 that's drawn, and the outstanding of 984, that's the community college. The one above it is for Flathead County Water. They have drawn about 100,000, they're about almost 95,000 outstanding. So just some clarity there, but the rest of the report is okay. I apologize I didn't catch that before it hit the books. So that is all I have, and welcome to answer any questions if anybody has any.
Jim.
I have a question, Lisa, on page 2 of the staff approved loans. The Big Sky School District. Seems like there is no other funding source here. Is that kind of unusual in that type of project? Or?
No, not at all. And that's something that our program offers is 100% financing, so they do not need to have match when it comes to our program.
I'm assuming the issue there is that there's no affordable housing for teachers.
Correct.
And this is maybe slightly off the topic, but it seems like in the community down in Gallatin County, there's been some conversation about having the businesses that are benefiting from this massive building that's going on down there be supportive of things like that. Has there been a project like that where it's kind of a...
I would think...
We'll be happy to lend this if you guys kick in.
I think there's one piece of that you might see with Big Sky with the resort tax in their area. It goes towards the rural fire. And we did do a loan with Big Sky Rural Fire, and part of their resort tax directly goes to fire services for that. So that's one piece of it. And I'm not sure when it comes to schools, I haven't heard of that just yet. And you're talking more like kind of an impact fee type scenario?
Yeah, it hasn't really been named, but
That's probably a bad word by now.
Should you have some participation because you folks are the ones really benefiting from the growth down here.
Right. And that community is growing leaps and bounds, so they have their struggles.
Thanks.
Anything else? Anything else? If not, thank you, Louise.
Thank you.
Doug?
Oh, great.
Right at the end of the day, when everyone's
Ready.
ready,
Chipper, cookie, sleepy.
I'm on tab 8. Good afternoon, Mr. Chairman and members of the board. The commercial and residential loan portfolio memo is in front of you. As of July 10th, the portfolio had a balance of a little over 167 million, which is roughly 111 individual loans or participations. We have 4 loan reservations that total 23,890,000. The sheets behind my memo, you can see the breakdown of the reserve loans and the committed loans if you do have any questions. There's 5 committed loans that total 38,671,500. The commercial loan portfolio, excluding the veteran home loan and the science and technology portfolios, has a yield of 3.01%. There's currently no commercial loans that are past due over 30 days. I'm happy to report that the on-the-border property in Great Falls did sell in June, so we don't have to have that on our books anymore. Good to have that done. The residential loan portfolio reflected an outstanding balance as of July 30th of $3,718,326. It's 95 loans. The yield on that is 6.62%. There's no outstanding reservations, and we do have 2 loans with FHA guarantees that are over 90 days past due. So we shouldn't experience any losses on that if those go into the default.
I have a question. So
Yeah.
how long before you actually consider them in default?
Well, the Board of Housing, services the loans for us. I mean, they're willing to work with the borrowers if there's a potential to recover. Typically it's past 90 days, but if the borrower has said, we're done, then you will institute, some action against them, either foreclosure or deed in lieu, to get that taken care of. Mark?
Yeah, I think FHA, if you're down 2 payments, which is 60 days, and there's all these loss mitigation requirements that have to be offered, but if there's no possibility of that, I do the foreclosure, so I know they refer them to me and then we can start the foreclosure, but I'm guessing these are probably either considering loss mitigation or about ready to be referred, or, does that sound right, Doug?
Yeah, and some of these have been chronic delinquent customers where they've gotten up to the point of foreclosure, which, once you start to initiate a foreclosure, it takes months to actually get to the sale date. And right before the sale date, the borrower is brought the loan current. We have a borrower that's done that 13 times. 13 times. And he's going for 14 here. He's paid a lot of attorney fees. A borrower.
I've had them, I had 1 or 2 of them that I went through about 10 years, just continual.
Yeah.
They just didn't scrape together the money to bring, I kept saying, we're making, my wife and I were doing this work. You're making us money, why are you doing this?
Yeah, I don't understand it.
Cyclical income usually is the answer.
Yeah. Okay. And then the Veterans Home mortgage portfolio has an outstanding balance of, as of July 30th, of $38,437,282. That's 227 loans. We have 11 reservations that total $2,602,889. The portfolio has a yield of 1.9%. There is 1 loan over 90 days past due that totals $174,971, or 3.46 of the portfolio. So it's a very low delinquency ratio for that portfolio. So, any questions?
I have one question. Is this write down less than we had originally thought the write-down was going to be on the board? Or is it more?
It's actually a little bit more,
A little bit more?
because, initially, we had the property listed at a certain price, and so we took a write down based off of that. Hopefully, the sale price that we thought we could get on it, the sales price came in lower, and so consequently, the write down was a little bit greater.
Other questions? The Springs at Bowling has an expiration date of last Friday.
Yeah, since this report was created, they have extended the interest rate and lowered the interest rate because rates have come down. So you would add another year to that expiration date for the Springs.
Oh.
This report. The cutoff on that report was July 10th, and the expiration date on the Springs.
What is the Springs in Bozeman?
That's the retirement facility that's behind Target. That's being constructed at this point. It's going very well from, according to Bank of Montana. The upfront reservations for the units and the construction and the whole process is ahead of schedule.
Why does it have an expiration date that's current, because you signed that way, so it's roll over and you're gonna leave a lot of constructions being done?
No, when the bank and the borrower decide to lock in the interest rate, that rate is locked in for a 1-year period. And if the loan isn't finished, and it's gonna go a little longer, the construction period is gonna go a little bit longer, then they will extend the lock-in period for, another year at that point.
That's the takeout loan.
That's the takeout loan, yes.
Okay, anything else? All right.
Okay, thank you.
We are, that's the end for today. And what's the,
6 o'clock at the cupola.
6 o'clock,
or
cupola.
the gazebo, as some people.
Yeah, whichever. Dress cozy.
Or what did I call it?
You called it the,
Gondola.